can hear me?
So once this is on, I will take the pre-program announcements, and exactly at 2 o'clock I will begin the program proper. Okay?
Good afternoon. Am I audible?
Yes.
Yeah. Okay. Thanks. Hi, Mansi ji. Hi, everybody.
Aniket, we can go live on YouTube.
All on mute, please.
A very good afternoon, everybody. On behalf of IMC Chamber of Commerce and Industry, it gives me, Manasi, immense delight in extending a hearty welcome to all of you, especially our distinguished guests, esteemed dignitaries, speakers, delegates, and all you participants to the inaugural session of the 11th Banking and Finance Conference with the theme, How Technology is Reshaping Banking and Finance. Ladies and gentlemen, this two-day conference has HDFC Life as platinum sponsor, and gold sponsors are BNP Venture Capital Limited and Standard Chartered Bank. Well, Reach Media Global is the webcast partner. We will commence with a film on IMC.
It is the long history of humankind that those who learn to collaborate and improvise most effectively have prevailed. A fine example of these words is the IMC Chamber of Commerce and Industry, formerly known as the Indian Merchants Chamber. The Chamber is the voice of over 200,000 corporates with a combined strength of more than 4,500 members and 220 trade and educational institutions. Identified as a chamber with a global presence, IMC is on the board of the World Chambers Federation and has signed MOUs with the United Nations and more than 150 other chambers of commerce across various countries and government agencies. With the numbers still growing, the IMC has gained the strength to be the undisputed voice of Indian industry.
We are very proud of the fact we therefore represent the cream of the cream industry in this country. On the one hand, we help our members. On the other, we submit recommendations to the government so that they can institute policies which can ease and accelerate the business in India. Our activities include running seminars, holding exhibitions, we host inbound delegations, we take outbound delegations, and we facilitate international trade, which we believe is crucial to India's development.
IMC has spanned over 11 decades. To understand the spirit of IMC, one must go back in time.
Indian Merchants Chamber started in 1907 under the leadership of the visionary Manmohan Das Ramji, the eminent Indian businessman.
The economic policies of the then alien government in India were dictated by associations which had no other interests but to look after the welfare of the colonizers and traders. And it was such associations, uncaring and unfair economic policies that made Indian traders and merchants realize the need to form their own chamber, Indian Merchants Chamber.
These gentlemen of great experience, great patriotism, lent their support, their advice and their knowledge to government in formulating policies.
I want to compliment the IMC on its proactive liaison and advocacy efforts with ministers, senior bureaucrats, and civil society. Its repository of accumulated knowledge, its long experience, and the cohesion amongst its institutional and corporate members enable the IMC to work very closely with the Indian government on policy matters essential for development and growth.
This was the only chamber whose honorary membership Mahatma Gandhi accepted. Starting with only 23 members, the IMC's membership grew over the years, with many prominent icons of industry as members, as well as parliamentarians and those who later became cabinet ministers. From Dr. Sarvapalli Radhakrishnan to Dr. APJ Abdul Kalam, and from Pandit Jawaharlal Nehru to Shri Narendra Modi, IMC has the rare honor of visits by almost all the presidents and prime ministers of India. Inaugurated by Sardar Vallabhbhai Patel in 1939, this prestigious IMC building stands in the heart of South Mumbai. In 1967, as a memorial for the late Mr. F.E. Dinshaw, a well-equipped commercial and financial library was built. The then Honorable Chief Justice of the Mumbai High Court, Mr. Mohit Shah, inaugurated IMC's International ADR Center.
Cases are pending for years and years. IMC has taken a lead and set up an international ADR center which will cover all alternate dispute resolutions, including reconciliation and mediation.
The IMC Praveen Ravi Gandhi Chair in Banking and Finance was instituted to perpetuate the memories of late Sri Praveen Gandhi, who was a trustee as well as a past president of IMC. The chair serves dual purposes: promote our own national university of eminence, that is the Mumbai University, and secondly, fulfill the long-felt need as there was no chair for banking and finance in the University of Mumbai.
IMC also has a strong ladies' wing, promoting professional excellence of women entrepreneurs.
In these past years, we have achieved a lot. We have empowered a lot of women from the urban sector. For impact, which we hold on Women's Day, we found that the woman artisan in the rural area is to be celebrated. So we synergized with the urban woman and the rural woman and brought each other into focus.
IMC initiates a number of conferences on topical national interests in various sectors like infrastructure, banking, financial services, aviation, urban development, railways, and many more. IMC also hosts a number of foreign and Indian dignitaries.
IMC approached me to help them get involved in actually creating a startup committee. Our agenda, therefore, was defined as thought leadership advocacy and partnerships, and extremely excited to participate with several youngsters from across the state, and we spoke about building companies and entrepreneurship.
A variety of awards have been initiated by IMC to encourage innovation, quality and development in various fields.
IMC is very proud to have the Ramkrishna Bajaj National Quality Award and the Juran Quality Medal. This we started over 20 years back to get Indian corporates to assist them to be able to focus on quality and compete in the world. I must also mention the IMC Juran Quality Medal, and that is given to an individual. The Ramkrishna Bajaj National Quality Award is for corporates, the most prestigious quality award in the country.
IMC encourages innovation, recognizing outstanding services and accomplishments of organizations and individuals with the Inclusive Innovation Awards.
And there was a reason to create these awards, Inclusive Innovation Awards. See, India needs growth, but it has to be inclusive growth. And for that, you require inclusive innovation, because it is only innovation-led growth that can take India up there.
In terms of social responsibilities, IMC has been active through a number of forums. As India races towards a bright future, the IMC is accentuating its progress with its vital strength and leadership by aligning its aims with those of the governments, ensuring India's transformation to a fully developed economy.
IMC will do everything in its power, and so will its members, to achieve this objective, to put India on that pinnacle which India deserves to be.
Our collective ambition must be to take India, Indian enterprises and the Indian economy to the top of the global ladder. Let us build a grand coalition of all Indians under the auspices of IMC for building a new India today. IMC will have a big role to play in building and nurturing this partnership.
आप जिस संस्था का हिस्सा है, उसका बहुत ही गौरवशाली इतिहास रहा है। स्वदेशी आंदोलन की पृष्ठभूमि में इसकी स्थापना हुई है, कुछ न कुछ योगदान दिया है, और इसके लिए आपकी संस्था प्रशंसा के पात्र है। आईएमसी मैं आपका बहुत बहुत आभारी हूं। धन्यवाद।
That, ladies and gentlemen, was the glorious journey of IMC, right from its establishment to all the major accomplishments, along with significant milestones on the way. We will now run a film on HDFC Life. Kindly take a look.
है जिंदगी तेरी छाँव में, कुछ सपने हैं बुने, उलझी सी तेरी राहों पे नन्हे कदमों से बढ़े। कभी जो जिंदगी ने नींद जगाया तो हमने ये खुद को समझाया। जो जिंदगी ने नींद जगाया तो हमने ये खुद को समझाया।
क्या हुआ?
कंपनी कुछ लोगों को जॉब से निकाल रही है और लिस्ट में मेरा नाम भी है।
कौन कहता है कि तुम जॉब करो? तुम्हारा तो हमेशा से मन था कुछ खुद का स्टार्ट करने का।
पैसे किसके पास है?
और सालों पहले हमने भी तो प्लान किया था। एक मिनट, हम तीनों के फ्यूचर के लिए, ताकि अगर मुश्किलें आए तो हम रास्ता भी खोज निकालेंगे।
जब फ्यूचर सिक्योर हो तो अपनों को मुश्किलें रोकती नहीं, नई राह पर मोड़ती है। अपनों का फ्यूचर इंश्योर करके उन्हें बाउंस बैक करने के काबिल बनाए। HDFC Life, सर उठा के जियो।
That, ladies and gentlemen, was HDFC Life in a nutshell for all of us. I will take this opportunity to make a couple of announcements. Kindly pay attention. The agenda and profiles of speakers are on the bottom right-hand corner of the screen, while the feedback form is in the bottom center of the screen. You all are requested to submit your questions in the Ask the Question section on the bottom left corner of the screen. Please specify the speaker's name to who the question is being addressed to. And don't forget to click on the submit button after the question is typed in the Ask the Question section. Ladies and gentlemen, your feedback is extremely valuable to us to keep improving the conferences and seminars. You all are requested to kindly submit your feedback form, which is accessible in the bottom center of the screen. I will quickly run you through the day's agenda. The welcome address will be by Mr. Rajiv Poddar, President of IMC Chamber of Commerce and Industry, followed by introductory remarks by Mr. Arijit Basu, Chairman, Banking and Finance Committee, IMC Chamber of Commerce and Industry, and ex-Managing Director, State Bank of India. After that, we have a fireside chat on corporate governance and sustainability in banks. We will have Mr. Richard Koolhoes, Director Group Sustainability at ABN AMRO, the Netherlands, and Madam Naina Lal Kidwai, former Chairperson, HSBC India. This fireside chat will be moderated by Professor M.K. Chauhan, Chairman, Fino Payment Bank and Vice Chairman, Global Advisory Board, Asian Center for Corporate Governance and Sustainability. Post this fireside chat, we have another fireside chat on rewiring for a digital and green economy. The guest of honor for this session will be Madam Usha Thorat, former Deputy Governor, Reserve Bank of India, and we have Mr. G. Padmanabhan, Senior Consultant, AZB Partners, former Chairman, Bank of India and former Executive Director, RBI, in conversation with Madam Lata Venkatesh, Executive Editor, CNBC TV 18. Post that, the vote of thanks will be proposed by Mr. Zuzar Khorakiwala, President-elect, IMC Chamber of Commerce and Industry. At 4 o'clock, we begin a session on investing in Indian BFSI, opportunities and risks. The panelists for this session, guest of honor, Mr. N.S. Vishwanathan, former Deputy Governor, Reserve Bank of India, Mr. Narendra Ostawal, Managing Director, Warburg Pincus, Mr. Avizar Divanji, Partner and Head, Financial Services, ENY, Mr. Ishan Mittal, Investment Advisor, Sequoia Capital, Mr. Vishwanath Patnaik, CEO, BNP Investments, LLC. The moderator of the session, Mr. Anant Narayan, Associate Professor, Finance, SP Jain Institute of Management and Research. At 5 o'clock, we begin the session on future of technology and sustainability in banking and financial services. This fireside chat with Mr. Bill Winters, Group Chief Executive, Standard Chartered Bank, will be moderated by Ms. Zareen Daruwala, Co-Chair, IMC Banking and Finance Committee and Cluster CEO, India and South Asia markets, including Bangladesh, Nepal and Sri Lanka, Standard Chartered Bank. The next session will be on redefining financial systems, fintechs and payment banks. Panelists, Mr. Akash Sinha, co-founder and CEO, Cashfree, Mr. Prashant Ranganathan, CEO, PayU Finance Limited, Mr. Manoj Sharma, Managing Director, MSC, formerly Microsave, Mr. Rishi Gupta, MD and CEO, Fino Payments Bank. This session will be moderated by Mr. PD Singh, MD, JP Morgan Chase Bank, India. And this will be the last session of day 1 of this 2-day conference. With that, ladies and gentlemen, let me request Mr. Rajiv Poddar, President, IMC Chamber of Commerce and Industry, for the welcome address. Mr. Poddar.
Thank you, Mansi. Dignitaries, distinguished delegates, ladies and gentlemen, a very good afternoon to everyone. On behalf of the IMC Chamber of Commerce and Industry, I extend a warm welcome to IMC's annual 11th Banking and Finance Conference, How Technology is Reshaping Banking and Finance 2021. I would like to compliment Mr. Arijit Basu and the members of the IMC Banking and Finance Committee for organizing this conference with such prominent personalities. As you've just heard the program, each session is better than the other one. So I request all of you to attend as much as you can. IMC's annual Banking and Finance Conference is a platform to spark a new dialogue, to explore the potential of technology, to scale innovation and transform the Indian banking landscape. The year 2020 threw a wrench into many plans and predictions with a sudden outbreak of COVID-19, which unsettled every human being on this planet. Digital transformation came to the rescue at such unprecedented time. Banking, being one of the core sectors of socio-economic development, expedited adoption of digital technologies on priority as the lockdown hit. The banking sector in India has experienced a radical shift in the recent years, and the very definition of banking has changed. In the past, net banking was limited to sending or receiving money. Typically, the process took a couple of days. Today, we have made such advancements in this area, be it creating new accounts or applying for personal loans. Digital banks have enabled consumers to avail banking services through a device that is conveniently placed in the palm of their hands. In addition to the financial collapse, COVID-19 is reshaping the banking industry in several dimensions, promoting new ways of innovation, ushering in a new competitive landscape, redefining the role played by physical branches, and ultimately accelerating digital transformation across every aspect of banking. Technology is poised to bring a major change to the banking sector. As such, artificial intelligence and various AI-backed applications such as chatbots, robotics, etc., have already started transforming the operational and customer services aspect. Despite the challenges like security threats, skepticism towards digital banking, lack of financial literacy and awareness, growing evidence thus reveals that digital banking has become the most favorite form and preferred form of banking even in India. The Indian economy has undergone a radical transformation in the last decade. The confluence of technology and finance, or fintech, has been at the center of the change. India has emerged as one of the financial fintech hubs in the world as a new age companies leverage technologies to change the way people and businesses avail banking and financial services. The fintech industry continues to expand at a rapid pace in wake of the COVID-19 pandemic. The fintech market in India, which was approximately at 1,920 billion rupees in 2019, is expected to reach 6,207 billion rupees by 2025, growing at a compounded annual growth rate of 22.7%. It has emerged as one of the most dynamic sectors of the economy, with offerings backed by blockchain technology, artificial intelligence, machine learning, and data analytics, a number of fintech products will find mainstream adoption in the future. With technological advancements happening in leaps and bounds, the future looks very promising as well as exciting. The advent of 5G, development and increased adoption of blockchain, unlocking benefits from AI and ML can open endless possibilities around use cases such as platform-driven KYC, block-driven settlements, etc. Lastly, it is clear that the increased use of technology is the way forward for banks. But what is also true is that there are uncertainties about execution. We believe it's time for banks and financial institutions to redefine themselves as agile technology companies. The banking sector will also need to examine the fundamentals sustaining their core operations as customer preferences, demographics, and lifestyles change. Today, with the cheapest data plan in the world, financial technology startups and digital banking service providers in India are staring at yet another boom in financial services on the horizon. The need of the hour is financial inclusion, not only bringing everybody under the formal banking system, but also making banking and fintech services easily accessible and affordable by people across the country. To reach to the masses in Tier 2 and Tier 3 cities, and more advancements are expected in the coming years that will work towards bridging and the widening digital gap between urban and rural people. With technological advancements disrupting at a rapid pace, we could expect financial inclusion to soon become a reality. I am reminded of a quote by Albert Einstein. In the midst of every crisis lies a great opportunity. This is the time and the opportunity to harness the power of technology and reinvent the banking and financial ecosystem in India. Leveraging technology to its full potential will not only stimulate growth, but will enable Indian banking and financial sector to be among the strongest, resilient, and most dynamic in the world. Before I conclude, I would like to briefly acquaint you with our chamber. Although you've seen the video very briefly, IMC Chamber of Commerce and Industry has a rich legacy of over a century of being in the service of the nation building and working for the benefit of trade, commerce and industry since its inception in 1907. Headquartered in Mumbai, the Chamber has since evolved into an industrial body that represents the voice of over 4 lakh businesses and industry establishments across India from diverse sectors of industry, and with its membership base of over 5,000 members and over 150 trade associations affiliated to it. The Chamber's core function is to provide policy inputs and to promote the interest of the industry and economic growth of the country. Once again, a very, very warm welcome and thank you for joining us. Thank you.
Thank you, Mr. Podar, for the initial cordial remarks and also for sharing your valuable thoughts with us this afternoon. I will now request Mr. Arijit Basu, Chairman, Finance, Banking and Finance Committee, IMC Chamber of Commerce and Industry, and ex-Managing Director, State Bank of India, for the introductory remarks. Mr. Basu.
Good afternoon. Thank you very much, Mansi. Thank you, Mr. Podar, for a wonderful speech giving the outline of the conference and what IMC stands for. I welcome once again all the delegates and participants who have joined in. And I think the session to follow as part of the inaugural session is on governance and sustainability, where I think one of the speakers has already joined in, Mr. Richard Kulus from Amsterdam, and warm welcome to him as well. For IMC, it's a wonderful opportunity to connect with the entire banking and finance community. In fact, I also had the opportunity a few years back, I think it was 2018, when for the first time I went into a panel discussion. Those days were better in the sense that we did not have to do it virtually, but we were able to meet, and I'm sure in the years to come that is going to happen. But this year, as Mr. Poddar said, indeed, on behalf of the banking and finance community, I must I must thank all the experts and distinguished speakers who have agreed to join in spite of their busy schedule. All of them are serving executives, most of them, and they become experts because they are serving executives and they can bring their knowledge to us. And it's a wonderful kind of, when we started conceiving this program, we were a little doubtful as to whether we will be able to get everyone together. But for that, I must thank each and every one of my co-members in the Banking and Finance Committee who worked very, very hard, and sometimes they had to, as you can imagine, getting this together is not very easy. I am not going to specifically take names because almost everyone contributed to this venture. And we have been able to get a very good panel together. A little more thought on what Mr. Poddar has explained about this year's conference. We felt that technology and related developments, and technology is a broad term which covers almost everything that is happening in the banking and finance sector. So banking and finance, as we all understand, all of us who are participating in this, is at the core of the economy, the global economy, the Indian economy. And when we, especially in times when we are coming out of a stressful situation like COVID, what we need to do is make sure that banking and finance works first. And I think all the steps, even in India, that the government has taken, starting from March 2020 when COVID hit us, most of them have been focused on getting banking and finance back on rail. And a lot of good work has been done by banks. I am still associated with the finance sector, but was very much part of the largest bank till a few months back. And how bankers reached out to the last mile, and people who needed succor. Within, I think, 10 days of the lockdown being announced, the government had announced a program to credit money into the poor people. We call them the Jan Dhan account holders, and it was done in a record time. I think credit of about 24 crore customers, or which would be 240 million customers, was done in the space of 3 days. So it needed technological capability and innovation. So that was one of the thoughts, that we should focus on technology for this conference. And at the same time, of course, it needed the human resource to be able to back it and get everyone together. So technology is, completely changing the way in which banks operate. And it's no longer confined to just having a core banking solution where everyone's account is in one place. It has gone much beyond that. And to my mind, it is all about customer experience, as Mr. Poddar was saying. The customer today decides what is the solution that he wants. And in case we are not able to live up to that, we would not be the banks which are not able to do that well, banks or financial institutions. In fact, the divergence between banks and financial institutions is slowly going away. Fintechs are emerging as banks, sometimes even without calling themselves banks. So this relationship is also something which I'm sure many of the panels will be addressing. So the panels also are very interesting. Today, of course, before the inaugural session, I would come to the inaugural session at the end because it is our most important session. But the other sessions that we have after this, there is one on the collaboration with fintechs, how fintechs are working together. And the other one is also very important for India, which is investors. How do investors look at India? Which is again very important. And a lot of investors, to my mind, are now coming to India because India has become a country, as Mr. Poddar said, which is adopting fintech in a manner which is perhaps a little ahead of what India would be expected to do as a relatively less developed country. I mean, I'm sure we have a long way to go on that, but that is what is interest. That is what is show the investors evince interest on India because of the fact that we are maturing very fast on the technological front. But there are a host of other things that they also look at, and that session I think will address that. Fintechs themselves, how they are changing, how they are collaborating. There is one session on that. Then the other thing that has happened across the world and in India too are the platforms. So now we know of open banking, neo banking, where you are not confined to one bank, and you put your open APIs on one platform, connect the entire MSME. India has 7 crores, would be 70 million micro and small units. So all of them can come on a platform and get connected to the corporate majors. So how do platforms manage this? And they are operating at huge scale. And some of these are homegrown platforms, and their founders and CEOs will be coming to speak on that. That would be a very interesting session. And to give a global perspective, we are very fortunate that one of the global banks, which is very active in India, Standard Chartered, their CEO, Mr. Bill Winters, will be with us talking to the Indian CEO of Standard Chartered, Zareen Daruwala, who's very much a part of our committee and has helped out in organizing this program. I think all of us will look forward to that. And also we look forward to the session in which Mr. Kamath, who is one of the renowned banking experts in India. So he was with one of our premier banks, helped establish it, and then went to a development bank heading the BRICS, or the new bank in China. And he's recently back and already back in business, because the government had to set up a committee last year to ensure how stressed assets are to be dealt with in this difficult situation. And RBI had given him the honor of chairing that committee, and he had recommended. So he'll be with us speaking on infrastructure, an area that he understands very, very well. And I'm sure that many of us who are participating here will be learning a lot from that. And finally, there is a session on with the bank CEOs and financial institution CEOs. So we have the chairman or CEO of India's largest bank will be there, along with chairman of CEO of a private sector bank and CEO of one of the largest private life insurance companies, who's again a member of our committee, Vibha Padalkar. And I also have the opportunity to participate in that session. So it's a very, very strong panel that we have over the 2 days. But we thought that while technology and investor and all that is fine, we cannot start or inaugurate a conference relating to banking and finance without touching on 2 very important aspects. And today, in today's global world, I think the aspect that really matters to us is people are concerned about not what is happening in the world right now, but what is going to happen to the world in the days to come because of what we do as bankers and financiers. So the concept of ESG, it's new, but it is being understood by everyone. As of now, I think to a large extent, it is confined to bringing out a separate report, which even my organization, my past organization, SBI, also does faithfully. But slowly it is getting integrated, and people are understanding. So if you have taken investment from a investor who believes or swears by the ESG guidelines, and if you as a bank were to lend against those principles, the investors can question you. So things are changing very rapidly. Sustainability is something which we have to really look at, and what we are leaving for our next generation, our children. And on top of it, we know from the time of the financial crisis in 2008, how important governance is. And I think the global financial system is today stronger because the governance structures that have been mandatorily put in place by Basel and others are today much stronger. So it's only fitting that our first session is on governance and sustainability. And of course, the introductions will be done by Mansi. But I once again, because we have an international guest whom I can see and I had the opportunity to connect a few days back. I warmly welcome Mr. Richard Kulus, and Mr. Chauhan would of course be moderating that session. The other session that we have is also equally important in the inaugural session, which would be, and Ms. Kedwai is also there. She is a renowned banker in her own right, and thanks very much to her for agreeing to join the IMC conference and for being part of the inaugural session. The second, after the session on environment and governance, we'll have one on economy and development, in which we have two former central bankers, very well-known, Dr. Usha Thorat, who are still very active, Dr. Usha Thorat and Mr. Padmanabhan, speaking on various aspects of the economy and banking with one of our very well-known moderators, Ms. Lata Venkatesh. So it gives me great pleasure once again to welcome each and every one of you, and thanks to all those who have agreed to join. A special thanks to the IMC team who have assisted not just the committee, but all the technical persons who have put in very hard work to get this together. I know how difficult it is to get such a thing together, led by Mr. Ajit Mundrulkar and the IMC team. Thank you, and I wish that the participants will enjoy the conference. Thank you very much.
Thank you, Mr. Basu, for your insights and also for telling us about the aims and objectives of this 11th Banking and Finance Conference, which of course is happening online due to the current health concerns. But as you rightly mentioned, we all are praying and hoping that by the time we meet for the next conference, it will happen physically and not virtually. So ladies and gentlemen, time now for a fireside chat on corporate governance and sustainability in banks. We have with us Mr. Richard Kulus, Director, Group Sustainability at ABN AMRO, the Netherlands. Madam Naina Lal Kidwai, former Chairperson, HSBC India. This fireside chat will be moderated by Professor M.K. Chauhan, Chairman, Fino Payment Bank and Vice Chairman, Global Advisory Board, Asian Center for Corporate Governance and Sustainability. Ladies and gentlemen, due to paucity of time, I will not introduce all the speakers at length, but we do have the agenda and profiles of speakers on the bottom right-hand corner of the screen. Also, you are requested to submit your questions in the Ask the Question section on the bottom left corner of the screen. Do specify the speaker's name to who the question is being addressed to. And don't forget to click on the bottom submit button after the question is typed in the Ask the Question section. With those little words, I will hand over charge of this fireside chat to Professor M.K. Chauhan. Professor Chauhan.
Thank you very much for that kind introduction. Good morning, good afternoon, and good evening, ladies and gentlemen, depending on which part of the world you are joining this conference. I'm extremely delighted to welcome you all to this flagship event of IMC Chamber of Commerce and Industry, the 11th Annual Banking and Finance Conference. A special welcome to our speakers, Mr. Richard Kulus and Ms. Naina Lal Kidwai. Welcome, Richard. Welcome, Naina, and thank you both for taking time out to be with us this morning. The theme of our session is corporate governance and sustainability in banks. Governance and sustainability, especially in banks, has taken center stage across the world, and we have two experts from banking industry, one from Europe and one from India. Mr. Richard Kulus, as you heard, is the Director of Group Sustainability at ABN AMRO, the Netherlands, and he's the most eminently qualified to speak at this session because ABN AMRO has featured in top 10% of the world's most sustainable banks in S&P Global Sustainability Yearbook for 2021. Congratulations, Richard. Now, We also have Ms. Naina Lal Kidwai, who is the former chairperson of the HSBC India. Naina is one of the most respected banker and sits on multiple boards as an independent director now. She has also sat on a couple of international companies' global boards like Nestle. Now, let me give you a quick background for the corporate governance in the banking sector in India. Corporate governance in banking has evolved over several decades, and there have been several committees on corporate governance in the banks, for example, Ganguly Committee, PJ Nayak Committee, etc. Quite a few reforms have been undertaken as a result of the recommendations of this committee, but I would say a lot still needs to be done. Let me take a few latest developments, in corporate governance and banking sector. On 11th of June 2020, exactly 1 year ago, Reserve Bank of India released a discussion paper on governance in commercial banks in India. The objective of the discussion paper was to align this current regulatory framework with global best practices while being mindful of the context of the domestic financial system. This discussion paper was placed in public domain for the feedback, and we received quite a rich feedback. Based on that feedback, a comprehensive review of the framework has been done, and a master direction on governance will be issued in due course. But in the meanwhile, reforms have been finalized and instructions were issued as recent as 26th April 2021, barely 3 months ago, mainly regarding the board, chairman, and certain board committees. If I have to mention one single highlight of this reform, I would say the element of independence has been recommended very strongly to drive governance structures and processes. Beginning with the chair of the board, it has been mandated that the chairman of the board will be an independent director. It's definitely a laudable reform. Second, in the constitution of committees, a greater element of independence has been mandated again. Audit committee, risk management committee, and nomination and remuneration committee, all three of them. For example, audit committee, only non-executive directors will be there in that committee, and it will be chaired by an independent director. Risk management committee, there will be a majority of non-executive director, and it will be chaired by an independent director. Similarly, nomination and remuneration committee, only the non-executive directors will be sitting on this committee, and the chairman again will be the independent director. And thirdly, the remuneration of non-executive directors and independent directors have been improved, though moderately, but yet this is a right step in the right direction to attract the good quality of directors, which is the need of the hours. So in addition to the sitting fee, the non-executive directors and the independent directors will also be entitled for a fixed remuneration, which can be fixed by the boards depending on the kind of time they give and the kind of responsibilities they hold for doing their work in the board. So having talked about the corporate governance in Indian banks, let me share what's happening in the international arena. Naina and Richard, both of you must be knowing there is an international network called the Bank Governance Leadership Network. So in the meetings held in February in London and in March in New York, bankers and the other participants and investors from around the world met and discussed the ways in which the banks are approaching the climate risk, sustainability as a whole more broadly. And the conversations revolved around 4 main topics, and I will enumerate it for them so that you can address some of them depending on the time that you have. Responding to the evolving climate risk, grappling with the response changes, exploring opportunities in green finance, which would be of more interest to Richard, and articulating and operationalizing the sustainability approaches. The discussion highlighted 3 key focus areas, and which initially in the introduction, Mr. Arijit Basu also referred to. ESG will continue to be the primary focus of the boards and investors. And market risk is a growing concern. Thirdly, the technology, which is the main theme of our conference, artificial intelligence, that carries risk, of course, but is also a very, very vast potential. So these, ladies and gentlemen, was a brief landscape in India as well as globally. Now, let me turn to our panel members. Let me first come to you, Richard. As ABN AMRO has featured among top 10% of world's most sustainable banks, please briefly take us through the sustainability journey of ABN AMRO. Please cover how did you begin this journey, what were the triggers, and how did you go about creating a sustainability strategy and action plan at ABN AMRO? Over to you, Richard.
Thank you very much. Thank you for having me in this wonderful conference. The journey of ABN AMRO started in 2010 after the split off of the old ABN AMRO and the subsequent nationalization and merger of the Dutch part of the old Fortis and parts of the old ABN AMRO that most of you probably know from a longer time ago. So we started this journey in the midst of a financial crisis after a forced merger to prevent our organization from going bankrupt. So not exactly the ideal situation to talk about long-term value creation or those kind of things. So despite the fact that the corporate governance code in the Netherlands specifically says that long-term value creation should be the prime focus of the supervisory boards, the independent board members of the organization, our organization was in survival mode. So sustainability started very small. But shortly after I started in this role back in 2011, the UN guiding principles were updated and financiers also became included in them. They got a specific responsibility. And that triggered us to start with our ESG risk management policy framework. We built that from scratch on the basis of the UN guiding principles and the OECD guidelines, so that we had an international backbone we can refer to, that we had a certain governance that we could rely on. In the meantime, we started to identify all the sustainability initiatives people started in their own departments or towards clients, because people tend to do that, categorizing them, supporting them, and supporting the most promising ones, sometimes just with internal communication, also making visible to everybody what success looked like nowadays. From all that, we derived a sustainability strategy and we started working on themes like human rights and climate change. We emphasized human rights and we looked for knowledge partners to help us with that. The result of all this is that we were the first bank globally to issue a human rights report in line with the UN guiding principles. So there again, we followed the UNGPs. We have been organizing human rights conferences on specific subjects like human rights defenders to gain knowledge and to share knowledge and disseminate knowledge. And all this was kind of allowed by our senior management more than it was supported. Sustainability at that time and age was still like a sideshow. It didn't touch the core of our business that much, apart from the risk management side. Then in 2017, we had a sudden kind of sustainability crisis. We were financing one of the owners of the Dakota Access Pipeline in the United States. And that pipeline was supposed to be crossing land that was historically owned by indigenous people. And in our ESG risk policies, we included the principle of FPIC, free, prior, and informed consent for indigenous people. So in line with our policies, it was very important for us to know if the indigenous people there, the Standing Rock Sioux group, agreed with the crossing of their ancestral land. And they did not. And after much debate with our clients, and of course in our own boardroom, we decided to end our client relationship because our client was not willing to change its position. And the very positive feedback, especially internally, that we stood our ground, that we lived up to our policies and principles, that was a trigger event. It made clear to the outside world, but also to our own employees, that we were serious about sustainability. That when the going gets tough, we really stuck to our principles. And shortly after that, my sustainability department was directly put under the responsibility of the CEO. So from now on, it was a focus area for the board. And I was asked to design a sustainability strategy for the bank as a whole, as part of the core strategy of the bank. So in 2018, sustainability had become one of the 3 pillars of our strategy. And interestingly enough, that meant that my team, Group Sustainability, was no longer in the lead. The governance changed. The business was in the lead. And then suddenly, they had the responsibility to implement this strategy and translate it into products and services towards clients. So we had to quickly adapt and take on the role to guide our business leaders on the sometimes narrow path of sustainability. And that's the phase we are currently in. Thank you.
Thank you, Carlos. I think what we get the loud and clear message here that tone at the top is extremely important. If the board is supporting and if sustainability is directly under the CEO, things are going to happen. And secondly, actions speak louder than the words, and therefore you dropping a particular client when it did not fall into your policy framework of ESG, that was a loud and clear message. Now, let me turn to Naina. Naina, you have been one of the most admired and seasoned bankers. Let me pick your brains, particularly on the challenges in governance in banks in India. And it will help, Naina, if you can share one or two governance challenges, each from PSU, as we call them in India, but they are state-owned enterprises for my overseas friends, and private sector banks, both. Over to you, Naina.
So thank you very much. And I must congratulate IMC for picking a subject like ESG to open with, so topical, so critical, and indeed one which must drive a lot of the way we at banks work in terms of who we lend to and how we lend, even as we drive our own ESG reporting. So governance. Now, governance comes under many definitions, but one of the key ones which you touched on was really the constitution of a board and its own independence. And I fear that in the appointment of board members at the PSU level, our public sector banks, the process of appointment and the independence therein itself becomes suspect. There have been efforts to ensure that this happens through what was set up as a committee in the Ministry of Finance, so that the selection process be widened. But I think first and foremost, caliber, quality, appointment, nomination, all establish that independence. And then the voice of those independent directors in terms of not just them being represented on that board, but the way the board functions are key. And I think in this, whether it is public or private sector across the board, and I don't mean just banks, we are on a path of learning in India. And I must say, the Indian boards I'm on, I believe are world-class. So it's not like we don't have world-class governance standards here. But we need to move the needle for a lot of the middle sector companies and others, public sector as well, to conform to those standards of governance in terms of the people that are there, but even more important in terms of the tone at the board and the discussion that prevails therein. So that on governance, I want to just bring in the whole ESG element because it is so key to us in banks. So governance at the board level. And the question I would ask is how much of ESG type of issues are getting discussed at our boards, and particularly our financial institution and banking boards. And if they are not being discussed, it is an area which clearly needs attention for two reasons. One, we are finding more and more that the investor community, and most of our financial institutions are tapping public markets, but the investor communities are requiring not just the reporting, but are looking at the DNA of an organization that is raising funds. And I can quote here that BlackRock, for example, recently cited ESG disclosure as one of the priorities of its stewardship program. So you're getting large investors that are requiring it, large activist investors from the sovereign funds requiring it. And then if you look at the World Economic Forum's Global Risk Report, they pointed out that ESG-related matters account for more than half of the world's top 10 risks in terms of likelihood and impact. So if I'm a banker, a financial institution, lending money, if I don't understand the risks that are embedded in ESG, and it is not part of not just our risk assessment committee, but the board that is requiring its management and the risk committees to look at these issues, then we fail in terms of governance at the board. And I would just end here by saying that so at one level, it is ESG generally. There has been a change in terms of environment and climate change now gaining precedence, where earlier society, social governance were indeed mentioned, but also at the social level that it goes beyond CSR, and it is not just the remit of the CSR committee, but the way we respond, particularly in, say, a COVID crisis, to communities, to our workers, to our employees, are all now, again, looking at the S part of ESG in a way which is very different to before the pandemic.
So thank you, Naina. I agree with you. I think you very rightly have brought out the major issue is of the quality of independent directors on the board and the process of selecting those independent directors and the voice that those independent directors have. And secondly, the center stage focus by the global investors. I mean, the famous letter of Larry Fink, which you mentioned about BlackRock, because ESG disclosures, they are becoming extremely, extremely important. Let me now turn to Richard for a second question. Richard, recently on 21st of April 2021, just 2 months ago, the European Commission announced the adoption of the Corporate Sustainability Reporting Directive, CSRD as they call it, and that is in line with the commitment made under European Green Deal. Can you please tell us and our audience a little bit more about it?
Yes, the reporting directive is part of a broader set of measures, which maybe most importantly, at least for our industry, is what is called the EU taxonomy. And the EU taxonomy is basically a dictionary that decides, what are the definitions on specific sustainability issues. What can we call green? What can we call neutral? What can we call brown? Of course, that's a political process. You can imagine with for example, Germany having stepped out of nuclear energy while France being fully basically running on nuclear power. It's a political process. But at the same time, it creates standardization. So whatever the outcome is, you get a standardized set of rules. And standardization leads to reporting. And that's what this directive is about. So that companies larger than a certain turnover and more than 150 people employed need to report on these non-financial issues, need to report on these ESG parameters and relevant material parameters. And therefore that allows both banks and investors to assess those reports and to include those reports in their financial decisions. So what this directive basically does is it helps, and helped by the other regulations, it standardizes this whole field. It creates a huge data stream, and therefore that allows both investors and banks to include it in their core decision-making models. So the financial, the credit models of banks and the investor models of investors. And that means that sustainability is really entering the core of banking, the core of decision-making processes. And then, at least in Europe, there is kind of the second wave where the European Central Bank says, by the way, banks, now that with this data issue is being resolved, that the standardization is being addressed, I want you to take into account the physical climate risk and the transition risk, and later on biodiversity and human rights due diligence risk will be included into your financial risk models, so into your capital allocation, your PD, your LGD, your economic capital, so that all these things which used to be called externalities, which didn't count. We didn't count them, and therefore they didn't count in the economy. That those are being basically helping determining the price of money, so that there becomes an alignment of the price of money and whether or not the activity, the underlying activity that we finance, is either supporting the transition or is working against the transition. So very black and white. You can say if you're doing an activity against climate, against the climate, the price of money will go up, and most likely also the interest of people to finance you will go down, and investors will start worrying about you because your long-term future may be in danger. So on top of the financial results of a company, being still the best predictor for the coming 12 to 18 months, this directive allows basically for investors and banks to create a long-range radar that says these ESG parameters, now codified and standardized and quantified, are now the best determined for the longer-term future of your organization. So that next to the short-range radar of financial results, you also have the longer-range radar of ESG results and ESG parameters. And that, I think, is, if you change the rules of finance, you at least are changing the way the economy runs and therefore the way society is moving. And this, of course, will go very slowly, but it will most likely have a very, very large long-term effect. And despite the fact, maybe to close off, despite the fact that this is only focused on larger companies, for a large company to be able to report these numbers, they need to also look at their suppliers and their supply chain. And those supply chain, those smaller companies or those companies outside Europe will need to be able to report the requested data to their buyers so that their buyers, the larger companies, can report them to investors and financiers. So this may very well have what they call the Brussels effect, that it's the stone in the pond that the European Commission throws may have an effect on a much larger group of companies, and may cause a much larger effect on the finance industry than just the banks and investors based in Europe. So and that is also, I remember back in 2017 when Larry Fink was in Amsterdam and it was on stage and he was asked about how big is the impact of ESG on your investment decisions. He said, well, the real impact can only be there once it starts to be standardized and quantified, so that it really becomes data driven and we can feed it in their famous Aladdin decision making model. And these type of regulations are showing that this is what's going to happen.
No, thank you. I think that's very important. The taxonomy is important, the definition, the standardization, and I think I would also say that harmonization of different reporting standards, Richard, and are extremely important. And that's why I'm quite happy I happen to be on the International Integrated Reporting Council as well as on GRI, some bodies. And I find latest, the SASB, that is Sustainability Accounting Standard Board, and IIRC have merged to create a value reporting foundation. So this harmonization is happening. As a result, this standardization which you're talking about is also going to happen. Thank you for that, Richard. Naina, when we talk of governance in banks, let me come to the risk aspect a little bit more. We have to discuss about it. Risk management is one of the most significant issues, and how can banks incorporate ESG considerations into the risk management processes and respond to the evolving climate risk? As you said that earlier, there was a more focus on social and other things. Now, climate risk has become one of the largest risks, barking in our face. So I'll repeat, how can the banks incorporate ESG consideration into the risk management processes and respond to the evolving climate risk? Over to you, Naina.
For banks not to do it in today's environment is fraught with danger. So everyone's doing it at some level. The question really is, are we doing it enough? And I can come at it in two ways. One is you see the very evolved thinking of the ABN AMROs, the HSBCs, the Standard Chartered, and indeed you will see that movement in the European community of banks. But to the extent in every micro market like ours, if those norms are applied in the Indian context, but are not followed by the larger bunch of banks and local banks, then it falls through. Because it doesn't matter if ABN AMRO turns away a client and that client can go get funding from someone else. So we have to look at raising the bar. By all means, let's have an Indian model, one that suits us, one that doesn't necessarily derive from the West, but we will have to conform across the banking industry to have at least a norm under which banks do not lend to certain type of organizations that follow wrong practice or don't comply. And then, of course, for those that need and want international finance and money, the standard and bar will have to be truly global. Now, talking about risk and how it is evaluated, the whole climate risk evaluation process now is evolving through stress testing. And it's something many financial institutions are following. The value at risk model or the VAR model is what is being used more and more for evaluating investments. And unlike conventional stress testing, there's no linear correlation here. And, it's scenario-based. So the scenario basis calculations, workings, discussion keep evolving. But it forces us at boards, it forces risk committees to be aware of the issues. And you'll be familiar at the boards that you're at as well, that you see the heat charts, which show whether areas are falling into categories of red or yellow or amber or green. And it gives you a sense as to how evolved your own institution is or your company on some of these parameters. But the scenario testing, planning, value at risk has become key for us at banks, but also at the corporate level. I think the whole other area which has emerged, and we've seen this in Europe, and it's one that we have to worry about, is stranded assets. That very quickly we have found some types of companies and products are just not getting funding for the love of money. And we have to plan for this so that we are not stuck with stranded assets in companies, in sectors which are indeed under a watch, or even as banks to be stuck with these sort of assets. And I would just add that in a recent turn of events, for the first time, CDP, which is an alliance of global investors with combined assets of over $10 trillion US, accused 37 Indian companies of allegedly not disclosing the full extent of impact on climate crisis, water shortage, and deforestation. So it's much wider than just climate. Looking at water, of course, is a huge risk for India anyway. We should be looking at water as a risk, but deforestation as well. And the names of these companies were published and more detailed disclosures sought. So you're getting this kind of noise also emerging. And given that we have a very large number of listed companies that rely on foreign institutional investor type of funding, this is at our doorstep right now. It's not an issue that we can push away.
No, that's very interesting. You talked about, about this scenario planning, and the heat chart kind of thing. And my sense is that this applies, you talked about stranded assets, Naina. And my fear is that these stranded assets might become toxic assets, if people do not move fast enough. And the risk is more into energy sector, for example. From fossil fuel, decarbonization, moving to, de-risking models and all, for example, oil companies, many other companies whose carbon footprints are very, and now this naming and shaming was not happening earlier, but the CDP, have been bold enough in their report to bring out this. So this is the real pressure that you earlier also alluded to, that investors are really demanding now. And therefore, my sense is that if these pressures continue, There'll be no way out. It will become the norm soon, and we have to find our own model here in India. So finally, now we are, I think, just 6-7 minutes away from closing it. I would like to meet our deadline. There's a question that I'd like to pose both of you, that how can banks embed sustainability in the lending policy? Because, you know, ABN AMRO did set an example by dropping a particular client, you know, but that may not happen with many cases and with many banks. So can banks really influence the companies who are seeking funding from the banks to become the ESG ready in practice? Maybe Richard first and then Naina. This is something I want to really talk both of you a little bit more about.
Yeah, thank you. Of course, it's never our aim to say goodbye to clients. I mean, that nobody wins. Then it's basically an admission of loss because you were not able to convince your client that a different strategy would be more worthwhile, and your engagement with the client failed. And then, but if you do sometimes have to accept the ultimate consequence. And in this case, it was visible. Of course, in other cases, it's not because it's done in a very quiet way. But it kind of slowly it changes. It's like changing this small rock in the river. It is visible, and therefore others may change their behavior in the future. To include it in risk management has been very important. And I stress that you know, we were always seeking, like, what kind of international framework can we connect ourselves to, so that you have a kind of a backbone that you can rely on, and that you can refer to, because whatever policy you make, it will never capture every detail and every dilemma that you are faced with. But basically, so in our know your client processes and in our risk analysis, we include ESG parameters. And like was addressed, is that it may have been, let's say, a more liberal point of view a couple of years ago. It is very quickly turning into, it's just very sensible business, because you are not only at risk of losing your reputation, but you're also at the risk of losing out really financial results if you are not taking into account ESG risk parameters. And, you know, we started, of course, with kind of a triage system saying, you know, those companies that run the biggest sustainability risks, and it could be health, safety, environment, like in the oil and gas industry, or things like the defense industry, which is always difficult, but also coffee and cocoa and palm oil and garment industry, etc. And basically, I think the effect is by doing our due diligence, by asking our questions, we make things important for our clients. Because if a bank starts asking questions, the treasurer or the CFO starts noticing. And that means that those people in that company that work on these issues, because almost always people somewhere in the organization work on these issues, they get more airtime, they get noticed, they get more resources. So, and at first we ask questions like, for example, do you have a community engagement program? Yes or no? And we do that to check whether the company was taking into account the importance of a good relationship with its neighbors, with its stakeholders living in the proximity of their facilities or their plants or activities. And that is important because if you don't do that, you also might result, it might result in business interruption. And that can cause a lot of financial risk. So, for example, this Dakota Access Pipeline issue, the root cause was that the relationship of the company with its stakeholders was not at par, was not up to scratch, because they were taken by surprise by the resistance against this. So today we're asking more in detail, like, how many complaints are you receiving per month? Even if the answer is 0, we get very worried, because you can't run a factory without complaints from your neighboring societies. So apparently the threshold to complain is too high. And if that pressure builds up, it may erupt one day. And that causes a financial risk. So, but if a company gets thousands and thousands of complaints every month, maybe your operation is in danger too. So it's not just asking the questions, but also learning to ask the better questions. And we're in the middle of the process of learning. We're not at all done. So, and what we learned is that with these questions, we ensure management attention on the things that may otherwise get unnoticed, and that we try to align the interests of the stakeholders, in this example, the neighbors, with the interests of the bank. And this, of course, does not solve all ESG problems, but it's a start of a conversation. And research has proven that engagement is most effective when it touches upon a subject that's already being looked at somewhere in the company. So, but it requires more attention. And what we can do as bankers is kind of raise the level of attention on this and also raise the bar. So if an issue is completely outside of the scope of the company, if they've never thought about it, probably the engagement will not result in a change of behavior. But if it's already kind of on the agenda, but quite low on the agenda, if your financier starts asking questions, it becomes a more important question. And then at the end of the day, of course, it's a dilemma because some people, NGOs will say, oh, the change is not happening fast enough. Your commercial people say, oh, I find it very difficult to ask these hard questions to my client because it's a client and we are in the business of serving clients. So that learning process internally and externally needs to take place. But by growing that, you're also not only protecting the interests of other stakeholders of your clients, but you're also protecting your own balance sheet. And once people see that, the willingness also from commercial bankers to get involved in this and to be part of this asking questions and not say, oh, this is this person from sustainability and he's asking difficult questions, but I'm still your friend, which also we engaged in the early days. That will change in saying, we're both concerned about the long-term survival, the long-term success of your company. And that's why we're asking these questions.
You're right. I think you can't just talk of sustainability standalone. It's a part and parcel of the bank. And as we say, asking question is a skill. And I'll compare it with the skill of independent director. The way they ask questions to the management to get into the probing mode and all. Similarly, the commercial team of the bank has to ask their clients, and if they just say that, oh, my sustainability guy is asking questions, so I am asking you, that may not really cut the ice. So thank you for that. Naina, last word to you.
I couldn't agree more with Richard and with you that asking the right questions, and I would say persist in asking those questions, ensures engagement. I think there is another level now that is emerging, and that is measurement as well. So you will see this more and more in ESG reports, and commitments by organizations to net zero, etc., are not going to be good enough as pledges. We are going to have to demonstrate, whether it is through SBTI or measurement, commitment that there will be progress year by year to a direction which may be set out as 2030 or 2050. And I think as this evolution happens, it will start with industries that are more energy intensive or those that are under much more of a magnifying glass. But it will begin to refine the process of reporting, but also this process of measurement. And I'm on a board which has embraced SBTI, and I'm very impressed to see how quickly the organization as a whole embraces it, because the CEO's tone at the top and the boards, of course, is absolutely where it needs to be. And in fact, the Chief Sustainability Officer, who's now been also made head of innovation, reports directly to the CEO and is in that top executive committee. So the importance given to the individual who is also shaping this thinking and driving some of this within the organization is important. In India, we largely find sustainability sitting under a CSR team. Wrong place. It's absolutely the wrong place. So we have to begin to think about how we bring ESG into the DNA of the organization. And I'll just end by saying that I'm all for engaging with the corporate. Exactly as Richard says, it's not fun dropping a client. Even a client that is listening, if we can bring them along and maybe even agree a charter of 3 years, directionally, this is what you're going to do. I think that would be success, even if you don't get them to toe the line day one. But bringing everyone along to a level which is better than where they started is going to be very important for us as bankers. And we can do it because, after all, without finance, the world doesn't move. So let's move it in the right direction.
So thank you, Naina. What a better note than aligning everybody towards sustainability and, trying to move the needle over a period of maybe 3 years. And so with this, ladies and gentlemen, we'll have to bring this session to an end. I'm afraid we are completely out of time. And I think, to me personally, and you will agree that this was like a master class on corporate governance and sustainability in banking. Therefore, can we have a round of applause for both of our panelists, Richard Kuluz and Naina Lalkedbhai. Thank you, both of you. Over to you, Mansi.
Yeah, thank you, Mr. Kuluz, Madam Kidwai, and of course, Professor Chauhan for that intriguing fireside chat. And we move on to our next fireside chat, which is on rewiring for a digital and green economy. The guest of honor is Madam Usha Thorat, former Deputy Governor, Reserve Bank of India, and we have Mr. G. Padmanabhan, Senior Consultant, AZB Partners, former Chairman, Bank of India, and former Executive Director, RBI, in conversation with Madam Lata Venkatesh, Executive Editor, CNBC TV 18. Ladies and gentlemen, participants, delegates, I will bring to your notice once again that the agenda and profiles of speakers are on the bottom right-hand corner of the screen. Due to paucity of time, I will not introduce everybody in detail, and you are requested to submit your questions in the Ask the Question section on the bottom left corner of the screen. Do specify the speaker's name to who your question is addressed to. And don't forget to click on the submit button after the question is typed in the Ask the Question section. So this was all about the question and answer session towards the end of the fireside chat. I will hand over charge of this session to Madam Lata Venkatesh. Ma'am.
Thank you very much, Mansi. I must first welcome Mrs. Usha Thorat and Mr. Padmanabhan. My thanks to them for actually setting the agenda. We were floundering on whether to have banking and economy, but both of them said that the agenda for the moment and the agenda for tomorrow is what we have to discuss. So Mr. Padmanabhan forced on us the agenda of digital India and digital banking, and Mrs. Thorat kind of forced the agenda for tomorrow, which is the green economy. Actually, perhaps it was the agenda of yesterday and we are already too late in that agenda. So have to discuss. But first, my thanks to Mr. Kuluz and Naina and Mr. Chauhan for already bringing to the forum the importance of the green economy. They were discussing it with banking. Today, with two former regulators with me, I want to discuss this more from a regulatory angle. Well, I actually wanted to start with the digital economy because we have a card issuer, we banned from issuing cards. We have the country's largest bank today told that you can't onboard customers immediately because you have to improve your digital infrastructure. So I thought the problems were on us. But let me start with the green economy first and come to the digital economy thereafter. Mrs. Thorat, my first question to you is, one central bank has already gone ahead and said that, I'm referring to the Bank of England, it has said that there is a need to embed climate change within the central bank's governance and risk management systems. Now, that is a big point. It's already 1.5 years old that BOE has set the agenda. Do you think the Reserve Bank needs to follow suit? You have to unmute yourself, ma'am.
Thank you very much, and thank you, IMC, for inviting me here today. I know I attended a bit of the previous session, and Mr. Chauhan had raised very interesting questions of both Mr. Kuluz and Naina. And in a way, they were trying to see how ESG matters and how climate-related risk can be embedded in the balance sheets and the approaches of the banks themselves and in the financial institutions. The question you're raising is what leadership can the central bank, can the Reserve Bank do? I think there's a very important role of regulation. Because in some senses, what we are really seeing today is a lot of externalities which need to be internalized. Whether it's accounting, whether it's balance sheets, they are not capturing all the kind of negative impact of businesses on the environment and on the larger public good. So there are huge externalities that are involved in this business. So in a way, internalizing the externalities becomes quite an important public policy objective. And therefore, that's where the regulator comes in. Not only the central bank, but it's also the role of other regulators. In fact, I'm on a SEBI committee, and there are very much discussions about whether ESG funds should be launched and whether, there should be a more responsible, there are people who want to do much more responsible investing. They want to do much more responsible saving. So then what are the standards that one would have? How do you get ESG scores for companies? How do you, what are you comparing with? Is it with a whole lot of NSE companies or are you comparing globally? And ultimately, it becomes all a question of where are you setting the bar? So I think the very fact that we are talking about it, I think is a very good initiative because this is really where it should all start. We should make people conscious and aware. And I think Nena and Chauhan certainly did a very good job there.
Okay. Well, Mr. Padmanabhan, before you wear the regulator's hat, please wear the banker's hat. You were chairing Bank of India and you are now an independent member in one of the banks, a large commercial bank. Do you think, what is the status now in boardrooms and, credit committees? Is corporate governance and sustainable seen as actually eminent commercial sense anyways? Is that realization already dawned?
Thank you, Lata. I think, first of all, thank you for inviting me in. I think as far as the Axis Bank is concerned, where I'm presently independent director, this issue is embedded into the process. That is something which is already there. So particularly in credit decisions, when we take a credit decision, this aspect is definitely looked into. For instance, if we are going to be funding an infrastructure project and the part of that, let's call it a road project, and it is going to pass through a forest, then the environmental issues and the related issues do get captured. And both at the risk management committee and at the credit committee, this aspect is being insisted upon. So that is something which is slowly coming into the Indian banking system. And as the previous, I think, panel flagged this aspect also. But are we doing enough? The question that Naina raised, I think that becomes very critical as to whether the system is doing enough. Or if it is not across the system, is it possible for a bank which is insisting on this to be losing business to another bank? And that becomes critical. And that becomes critical from a banker's point of view. I would like to add another aspect as to, as we bring this in at a national level, international level, macro level, I would also argue that it is important to have policies or principles which are set for the next 5 or 10 years. Now, if you're going to give a concession for next 1 year to an electric scooter, what happens at the end of 1 year, nobody knows. So I think that the policies which are set by the government, the regulators, all this needs to have a longer time frame when we are breaking into an important area like this.
Okay, I absolutely take your point, sir. It could be possible that one bank, say Axis Bank, takes a decision that it will not fund a solar company, for instance, which is the fashion of the day, unless it has a credible plan on how the panels will be destroyed at the end of the 20 years. But another bank which does not have that social risk, which is not conscious of that or does not want to be conscious of that, is able to give the loan at a lower rate because it is not factored in the cost of the destruction of the panels. So, Mrs. Surat, that directly comes to your point. The regulator has to take the lead. And I'm very glad to learn that you are in SEBI. It is very important that regulators should be sharing each other's seats. If How do you think this starts? Do you think an FSDC or a SEBI or an RBI should now take leadership? In your time, either Dr. Reddy or somebody used to make a speech and flag off that this is our concern. So do you think the time has come for the RBI governor or somebody in finance ministry to say this is the agenda going forward?
I was just going to say that this is really an issue of financial stability. And Padmanabhan absolutely says the right thing. That is, you have to look at it as a very coordinated vision going forward and lay out a roadmap. In fact, that is what the FSB has called for just last week, a roadmap for whole climate-related disclosures and to embed this in the financial decision making. So I think whether it is IRDA, whether it is SEBI, whether it's PFRDA, it's all about investing, lending, and the overall objectives of the sustainability. So I think it's very essential that this is a matter which is clearly addressed at a coordinated with the government as also the financial regulators, focusing as ideal subject for the FSDC, no doubt about it. And there is a lot that we can learn. Already there are these, the task force on climate disclosures has already brought in a template of reporting. SEBI is already working fairly in advance of this, and they are also bringing in a whole new reporting standard for ESG reporting and also sustainability reporting. So I think these will become standards, and then they'll start getting adopted by the accounting firms. Also, there is another whole aspect which he talked about, externality. Now, unless one starts bringing that into the general accounting and national accounting, we will never really price risk properly. We will never cost properly, we will never price properly, we'll never even measure risk properly. So that is something which through the Paris agreement, and now with US on board, I think there's a huge opportunity that one can go much better, because it has to be not only a collaborative effort amongst regulators within a country, it has to be a global collaborative effort. And that
what about measurability, ma'am? I take your point on disclosures. Maybe we can start with disclosures. But what about enforcement?
See, one part is measurability, because unless you have metrics, and these have to be fairly granular, because it's not black or white. It goes, they could be, and when we do need infrastructure, right? And infrastructure generally means some kind of a compromise with some environmental issues. And there are mitigants. So one is looking at all of it in a very, and there also cost benefit is there. And there too, internal costs, external costs, shadow pricing, all that comes into the picture. So the whole thing has to be in terms of measurement, and then only you can. So measurement is where the work is really being done now. But there requires a huge amount of changes in the system from all levels, taxonomy level, of course, touched upon, but also from the point of view of all the regulators and also the banking system and the financial system. There is another aspect I think is very important when we look at this whole thing, is also our whole, when you look at India and you think of India as 70% living in rural areas, and you think about water, and you think of land, and you think of forests, and you think of communities, there's a huge amount of issues relating to climate change and crisis, and our food security, and what impact it's going to have on agriculture, what impact it's going to have on our GDP, inflation, everything. So therefore, central banks also have to get into it directly, because it is going to impact your ability to be able to do inflation management, projection, and so on.
Fair point. But, I'll ask one more question on this to Mr. Padmanabhan, and then go to the digitization, which I think is a crying need as well today, which the regulator is facing from all quarters, facing it from big tech, facing it from banks, facing it from a customer angle as well. So I do want to discuss that topic. But Mr. Padmanabhan, just to extend what Mrs. Surat is suggesting, it is not as if we have been entirely blind to the environment impact assessment. Every infrastructure project has an EIA, the environment impact assessment, has been done for a couple of decades now. But it gets into a huge political mess, because it could mean rehabilitating people, it could mean just polluting some places because you're given permission for a mine. several things. So do you really, it requires a lot of political will. It is not something, ultimately the central bank and the SEBI are bureaucracies. They are owned by the government. They are agents of the government. Are we, sensitizing the wrong people? This should actually be a political sensitization, isn't it?
No, completely agree. I think the point that Mrs. Kurat was making is that today it has become important to get this done in a very coordinated way, because otherwise I think we are getting into big trouble. Now, this becomes particularly important because we are a reasonably open economy. And today it is not a question of, our bank, our competitor, our government. We will have to be answerable to the investors and who are coming from overseas. So that becomes a very critical point, and time has come for a very coordinated effort. In fact, I would make 2 points, 2 pointed issues. One is this: I think the important point that was made is that all regulators will have to get together. Basically, what we are saying is that if you are not compliant, you will not be able to raise finance from the system, either from the banks or from the capital markets or in any way. So everybody will have to work coordinated manner. And ultimately, who should ensure that this gets done? I think you are spot on. It's the government. And about the political will, I think if this government is not able to get it done, who is able to get it done? They have the majority and they can get it done. So probably we are at the right time to get this done.
Lata, I'd also say there is another political angle to it, and that is that calamities are going to increase. The pandemic has shown us that the huge importance of public health and the need to ensure public health. Similarly, there are going to be many more calamities which are just not going to have deaths. In fact, there's a comment that the world is heading for a mortality rates equivalent to the COVID crisis every year by mid-century, unless action is taken. So it's something that's global. It's again not something that's India. So I think there is a political, it should be realized that there is a huge public angle in this, and there is a political angle. It cuts across food, agriculture, rural population, everywhere. So I think it is something that the political agenda is there. After all, we have also been part of the Paris Agreement. We have taken certain commitments and so on.
Well, maybe this incessant rise in petrol is actually a surreptitious way in which the government is moving people away from fossil fuels into maybe cycling or electric vehicles.
Once they start pricing water and power, I would think it would be a huge step forward.
Yeah, no, fair point. Just a point on what Mr. Padmanabhan is saying. If governments with extraordinary majorities don't do it, who can? I'm just emerging from a discussion with your former boss and my guru, Dr. Reddy, where he actually proved empirically that coalition governments have been more reformist than governments with absolute majorities. But that's in a lighter vein. I take your point that.
But exceptions do happen.
Yes, sir. They probably proved the rule also. Mr. Padmanabhan, time permitting, we'll try and come back and take some more lessons from you or thoughts from you on the green economy. But I do want to handle a couple of questions on the digital economy. I have 2 former regulators with me, and so I must, use that advantage. Now, what has come to the light is the central bank pulling up a bank which was almost state of the art in terms of digitization, or even the NSE being pulled up for glitches. But we don't see any instances of the regulator not pulling up several banks for not digitizing enough, for not investing enough. The core banking solution you were telling me when we were preparing for this is pretty old. So do you think that is where we are ignoring what needs to be done to digitize the banking system?
That question is to me, right?
Yes, Mr. Padmanabhan, to you.
Okay. I think the issue is that while the digitization can be pushed, now it's a different matter if we get into a discussion whether the digitization can be mandated. Now, because I think it depends upon the ability and the willingness of the people who use the system, they should be able to also use the system. It's not the banks digitizing everything. If there are 80% of the customers are not prepared to use digital banking channels and want to go physically to the branch and do the transactions, I don't think anybody can. So it's a question of constant, sort of push, encouragement, cashback kind of facilities that happen. Now, you specifically referred to the two instances. I think it is important to understand the issue and the beauty of the problem as far as this country is concerned. In fact, since I headed the IT and the payments, and both were reporting to me as executive director in India, the biggest problem that we faced whenever we were implementing something new was not the technology problem, not the availability of the professionals problem, but genuinely, how do I size my infrastructure? For a country like ours, which is starting on a low base and enormous possibilities are taken. Take the case of UPI, for instance. 4 years ago, we were talking in single-digit millions. Today, we are talking in terms of billions. Now, that kind of increase in the operations, transactions, how do you size for the infrastructure is a critical aspect. So what you call as a state-of-the-art in the IT world could last for 3 months in India. After that, you will have to upgrade your infrastructure on a continuous basis. And if you are not doing, then there is a problem. That is one issue. The other issue is also very critical because there it's a question of the customer's access, which means that how robust is your infrastructure. Now, the robustness of the infrastructure, particularly critical infrastructures in the financial sector, cannot be tested on paper. It has to be tested in practice. Now, I draw your attention to a latest guideline which the Reserve Bank issued, not directly related to this, but in a way related, where they said that from critical positions, we want you to send people on leave on a surprise basis. It is not the leave they choose, but it's a leave which I order to make sure that systems are in place and checks and balances are in place. I adopt that to the technology and say that your robustness of your backup or business continuity infrastructure will have to be tested unannounced in critical infrastructures to make sure that we really have these infrastructures. So to put your question and answer, 3 issues: sizing is an issue, the continuity planning is an issue, and in a country like ours where the digital adoption is so low and there is hesitancy, we will have to have a continuous sort of customer education, and because one bad instance can take me back to the cash account. It's easier. So that is how we need to proceed.
Okay. So this unannounced leave, if you can just phone my boss and tell him that it is some idea even he should adopt, it will greatly help me getting leave. Most useful. Actually, you raise a very important point that an Indian bank has to handhold several centuries in one. It has to handhold several people who want to come to the branch and feel the branch practically on a daily basis. My father used to do that. And it also has to handhold customers, or at least provide the backbone to customers who would see a branch and see old world, who are, so different in their approach to finance. So we are asking a lot of the banking system, and if you're going to impose environmental responsibilities on them, we have to think about how profitable or how sustainable they are to be able to take so much on their net worth and on their balance sheet. And on that issue, one concern that comes to the mind is that there is a huge challenge to the banking system from the payment players. That is big tech. They are anyway advanced in terms of the technology because they're technology companies, they're not finance companies. They don't have the legacy issues of an asset liability, of an asset problem of the last 2 decades or something like that. Obviously, state of the art in terms of people. And they don't invest in, your KYC or cyber security. They're just taking the data. For instance, Google Pay and WhatsApp Pay may be round the corner. take mine probably 10 times what one bank's data would be, because they cut across banks, and they could very easily be selling products which can take away the bank's business. This is what bankers smell as the danger of tomorrow. As a board member of a bank, do you think this is a danger and something the regulator should be aware of, protect the banks from?
Yes and no, because if you look at how the Reserve Bank of India has moved in respect of particularly trying to regulate the payment aggregators, this is I would presume that this is on account of the fact that when these big tech companies are connecting through a small bank into the Indian payment system space, we have a classic case of tail wagging the dog. So if you lose completely the sight of the control over the kind of security issues and the other issues that is being done by the aggregators, then you completely lose control over the system because it's an interconnected system. So in a way they have moved. But the point is that I think sometimes I feel that there is a bit of let us say over complaints from the banking system for the simple reason that unless these people are coming in a space where the banks are not able to deliver, and most of them are able to compete. And as of today, I don't think Reserve Bank of India has permitted the money to be retained outside the banking system.
No.
They may be connecting customers, but ultimately the money remains with the bank. So if it's a question of more business for these companies, automatically when the two banks are on the either end where the credit and debit happens, then obviously it's more transactions and more money for these banks also. In fact, the other side complains, the point that you raised in the beginning, is that the scaling up which is possible, which they are able to bring on board, is constrained because most of the core banking systems run by our banks are maybe a decade old. They are not able to keep up with the pace with which the transactions can happen today. So I think there has to be a balance, and the right balance will have to be found. It's a trial and error.
Yeah, Mrs. Thorat, your reaction.
I think, see, banks have to understand they do have some strengths. It's not as if their big tech is going to take all their strengths away. They also have either implicit or explicit deposit insurance. They still, the liability franchise is still with them. So I think, and they also have the comfort that they are highly regulated. It's also a regulatory cost. It's also a compliance cost. But the fact is that they are the custodians of money in this country. They are the biggest custodians of money. So and I think competition is a very good thing. I mean, Padmanabhan and I will remember when we were, talking about mobile banking, and we really literally felt that the banks had been given too long a rope and they were not coming forward with the kind of changes they ought to have come. And so there is a need for banks to pull up their strings. And actually this entry of big tech actually makes the banks, actually come and then perform. So I think upgrading, taking on customers. Also, the biggest challenge, of course, is of being, of catering to this very wide cross-section, language, culture, class, community, everything, which is, I think, for the Indian banking system, perhaps the biggest challenge.
Okay. No, there is, like I began by saying, the Indian banking system has to cater to a person from the 19th century, a person from the 20th century, the 21st century, and maybe the 22nd century also, which is what the kind of challenges.
If I may just add, I think one of the strategies that at least Axis Bank has thought about now is that we are in the process of putting up a separate, what we call the digital bank. I very much doubt whether this would have been even thought through if this competition had not come.
Yes.
So in a way, these are the point that Mrs. Thorat made. This is making changes. People also think and make changes.
Okay. Well, so
3 points I just want to flag from the point of view of level playing field, enough competition, stability, and innovation at the same time. So it's not as if the regulator has to ensure innovation and ensure stability. So there is always this tension between the two things, and privacy, data privacy. So I think all these things are terribly important from point of view of a consumers.
Yeah, I could add even cybersecurity over there. I mean, privacy is a subset or perhaps an allied responsibility of cybersecurity. So clearly the regulator and the financial system has its hands full. I still have about 2-3 minutes from the time allotted to us. So, Mrs. Surat, to come back to where we began, we are discussing the green and the digital economy. What would your, key message or ask be from the regulator and the government?
I don't know whether I should be asking from regulator, but what I would like to have from the system is that we have to use technology. We have to use the digital technology to be able to take much better decisions in our investments and in our financing. One example which I would give is the infrastructure financing, where actually there are, you can monitor the entire process of construction through drones and through satellite imagery. So you can monitor, if you say there is a mining company who've said that we'll restore that entire area to absolutely virgin-like conditions, all their promises can be monitored. Today, digitization can help you look not only at can make you do scenario analysis, all that is fine, but can actually make you validate those disclosures through actually sensor imaging, satellite imaging, and a whole host of artificial intelligence. The whole technology is opening up the opportunity to manage all these risks in a much better way. So I think there is also huge scope in terms of looking at the loss of biodiversity. There is a satellite-based, GIS-based technology which can say where the water is. What is it you should be doing for water in this particular state? And how can you go about in a well-planned scientific way? It's all thanks to technology. So I think technology and greening are going to go hand in hand and completely provide an opportunity and for the first time perhaps really meaningfully look at risk in a very significant way.
Okay. Mr. Padmanabhan, any final thoughts?
No, I completely agree. I think both of us are sitting on a board in one of the states, an infrastructure board, where we have actually seen some of these things happening. It's very interesting. I mean, a state which was known to be a laggard as far as infrastructure was concerned, they have made enormous progress because of technology aiding them. And we have actually seen and experienced. That's the point that Ms. Thorat is making.
Okay. Well, Mrs. Thorat and Mr. Padmanabhan, thank you very much for one of the most enriching 40 minutes of conversation that I have had. We began, if you remember, when we were preparing for this discussion by wondering whether we are discussing two distinct topics, the digital economy and the green economy. But what our participants are proving is that instead of looking at big tech or technology as an opponent which is taking away business, it is actually an enabler which enables the green economy actually. So both are pursuing change and serving humanity in a stable fashion and yet an innovative fashion. Thank you very much for a wonderful participation.
Thank you.
Thank you.
Back to you, Mans.
On behalf of IMC, I once again thank Usha ma'am, Mr. Padmanabhan, and of course, Lata ma'am for this absolutely engaging fireside chat. And now the vote of thanks for the inaugural session will be proposed by Mr. Juzar Khurakiwala, President-elect, IMC Chamber of Commerce and Industry. Mr. Khurakiwala.
Good afternoon. I hope I am audible.
Yes, sir, you are.
Good afternoon, everybody. It is
Sir, we've lost you. Okay.
Inaugural discussion on corporate governance and developments in the economy and banking sector. Both aspects are very important for a resilient banking finance sector, and we had leading experts sector deliberating on these subjects, making the discussion a very enriching one. I'm sure all of you have really enjoyed it. The chat we had on sustainability and governance led by moderated thank him for his excellent moderation on this. And I must thank also Mr. and Mrs. Former chairperson of HSBC India for her insightful perspective on corporate governance. Thanks are due to Mr. Chauhan, who moderated so well, chairman of Fino Payments Bank and vice chairman, Global Advisory Board, Asian Center for Corporate Governance and Sustainability. The next fireside chat was created by Lata Venkatesh so brilliantly, and I must thank Mrs. Usha Thorat and Mr. G. Padmanabhan, Senior Consultant, AZB Partners, former Chairman, Bank of India, and former Executive Director, for accepting our invitation and giving us such a wonderful opportunity to hear the digital and the green coming together. IMC's two-day bank is designed to get insights on how technology is reshaping banking and finance and how banks could contribute to India's accelerated growth. Our conference this year will have several sessions that will focus on this vision and discuss how technology can assist in making this a reality. I would also like to put on record our gratitude to Mr. Arijit Vasu, who gave a complete overview of these 2 days session on sustainability and governance. He has taken immense trouble to put this whole event together as chairman of IMC's Banking and Finance Committee for conceptualizing and structuring such an interesting conference and getting prominent personalities in the domain to speak at this conference. I wish to express a profound thanks to our platinum sponsor HDFC Life and our gold sponsors BNP Venture Capital Limited and Standard Chartered Bank. Without its gracious support, this would not have been possible to hold this event. We look forward to the continued cooperation in all our future endeavors. Our sincere thanks to media representatives for their participation and to all the delegates for joining in such large numbers. And last but not the least, thanks to due to our IMC team led by Ajit, officers in charge Bharti, Sonke IT team, our platform partner Reach Media for all the hard work in putting such a flawless execution. Thank you once again. Thank you all. Good evening.
Thank you so much, Mr. Korakiwala. And with that, we conclude the inaugural session of the 11th Banking and Finance Conference. We move to a panel discussion on investing in Indian BFSI, opportunities and risks. The panelists for the session are Mr. Narendra Ostawal, Managing Director of Warburg Pincus, Mr. Abhizir Divanji, Partner and Head Financial Services ENY, Mr. Ishan Mittal, Investment Advisors, Sequoia Capital, Mr. Vishwanath Patnaik, CEO BNP Investments LLC, and the guest of honor for this session is Mr. N.S. Vishwanathan, former Deputy Governor, Reserve Bank of India. Welcome to you, sir, and welcome to all the panelists. The moderator for this session is Mr. Anant Narayan, Associate Professor, Finance, SP Jain Institute of Management and Research. Ladies and gentlemen, I again draw your attention to the fact that the agenda and profiles of speakers are on the bottom right-hand corner of the screen. All those who have queries can submit their questions in Ask the Question section on the bottom left corner of the screen. Do specify the speaker's name to whom your question is addressed to. And also, do not forget to click on the Submit button after the question is typed in the Ask the Question section. With those words, I hand over charge of this panel discussion to Mr. Anant Narayan. Sir.
Thank you so much, Mansi. I hope you can hear me.
Yes,
I can hear myself, my own echo, so I guess that's fine. So thank you a lot, and it's a whole host of experts here with us. It's a real honor to welcome all of you. Guest of honor, former Deputy Governor N.S. Vishwanathan, Abhizar Divanji, Narendra Oswal, Vishwanath Patnaik, and Ishan Mittal. We will hear from each of you separately. The topic itself, investing in Indian BFSI, opportunities and risks within the umbrella of how tech is reshaping banking and finance. You can't ask for a more mother of all topics, really. It's vast, and like the proverbial Mahatma Gandhi's elephant, you can slice this particular topic whichever way you want, depending on your particular perspective. Now, we've got a really eminent panel. They are not blind men. They can give us both a bird's eye view as well as a worm's eye view of a particular topic. And I will actually leave it to them to choose what they want to focus on. Personally, when I come across a topic like this, I can see several strands emerging. So first, do you want to talk about India's digital stack and what that means for BFSI, both existing players as well as new entrants, fintech, and so on and so forth, both in terms of opportunities and risks? Or if you're talking about investing in BFSI, the inevitable question is about distressed debt and both the opportunities and risks that come along with it. And we are expecting some imminent announcements in terms of the NARCL, Bad Bank, and so on and so forth. So that becomes a topic difficult to avoid, even though we're talking about technology here. Alongside that, there's also this whole question of privatization of Indian banks, something that the government has stated as a policy. Again, it's a very hot topic in terms of investments into BFSI. So that could be an area of discussion as well. And finally, you could also have things to do with the product and market mix, things like trading in distressed debt, ESG that some of the earlier panels discussed so eloquently. There are other topical issues, for instance, the recent couple of bans on a couple of American players in the digital space over the onshoring of data. So frankly, there are plenty of topics one could choose from. But as I mentioned earlier, the initial part of this discussion, I'm going to let our eminent panel decide what they want to speak about. So each of them will speak for about 6 to 7 minutes. I will not presume to put a time to Mr. Vishwanathan, but otherwise the others will stick to 6 to 7 minutes. Thereafter, we'll have about 25 minutes of Q&A. And I strongly advise all participants who are here to please send in your questions. We'll try and implement and make sure that we squeeze out as much of knowledge as possible from each of these eminent panelists here. We're going to start with Vishwanathan. Again, in the interest of time, I'm going to be very rude and not really introduce him. He doesn't need an introduction. Former governor of the RBI, he was in the hot seat during many momentous events that impacted BFSI. He continues to be involved in the regulatory space. He continues to be the chair of the College of Supervisors, and in that capacity, he continues to be involved. I'm sure the RBI still calls him up for all sorts of questions. And from a personal perspective, I can only say that he's extremely knowledgeable, very thoughtful, and of complete unimpeachable integrity, something that you come to associate with the RBI anyway, but he epitomizes all of that. Mr. Vishwanathan, sir, the floor is yours. Your take on investing in banking and BFSI.
Thanks for very good introduction. Liberal at that. And thanks for giving me an opportunity to share from a very time. When you look at opportunities and risks investing in the BFS in the context of project developments in this area, there are many strands that come and very funnily or coincidentally, some of the thoughts that I'm going to bring in are among those what Sanand has kind of highlighted. So I'll kind of begin with a broader statement to make, which is a very strong view, which is that the BFSI sector in India rebounds in opportunity. This, of course, comes essentially from a huge untapped market and therefore potential for growth. And for like for example, we have data which says that about 80% of the population in the above 15 years of age has a bank account. At the same time, close to 59% of the agriculture, marginal and small farmers are not tapping the commercial banking segment for credit. Similarly, only about 10%, or I was saying that the segment of people above 15 years of age who access bank or credit is, unaccessible. People who don't have access today is about 90%. As far as so we are looking at a huge potential, particularly in the context of India becoming a growing emerging economy with earning middle class. So what does this happen? Why is it important, and why in the concept technology it's important is the point which Krishnan made, which is India digital stack. So whenever you go, even international, whenever in international forums, the India digital stack is something that is spoken about, and normally it begins with Aadhaar, and then you have the eKYC over it, then you have the e-sign, the digital locker, and the UPI. So, each of these has been getting added to the stack almost every year. So, started in 2011, 2016, we have the UPI. And it provides an amazing, access to data or ability to manipulate data to get information of the kind that is required to penetrate financial services in a safe manner and in an efficient manner. So, what I thought is what this is done is kind of metamorphosed how the front end of the banking and the back end of the banking services in general, or maybe it's in a way even in the insurance service segments of in the BFSI sector, how this functioning has undergone a change. So I can speak from the regulator, RBI regulator perspective more than others. So what has RBI done to leverage this? So one interesting thing is RBI had this requirement of banks having to open 25% of the branches in that bank area, and the concept of what is a banking touch point was always what is called as a brick and mortar branch. If we didn't have a brick and mortar branch, you have not met the 25% criteria, and the brick and mortar branch could have a huge fixed cost, and what RBI did was, because of the advantage of technology and the ability to use the banking correspondent network, we moved the reckoning of touch point for banking services from brick and mortar branch to a banking, ultimately which brought down the fixed cost of running a bank and making it possible to penetrate banking services to areas which might not have been as viable to run a brick and mortar branch. Second, very interestingly, RBI also brought this concept of digital NBFC. So it created a separate, framework for licensing and guidelines for how a digital NBFC can operate. What it did was, created in the regulator space, unlike those lending apps, the infamous lending apps, so to say, a framework for entities in the regulated space to function in an efficient manner. Third, I think, again, Sanat had highlighted this now, like bank licensing is an open drive. Open licensing, so anybody can apply anytime. The person is fit and proper and has the capability to run a bank, we can license it on tap, as they call it, as opposed to being licensed on spurt. So there is a market to penetrate. There is opportunity to get in because the licensing is on tap, and then you have multiple ways through which you can reduce the cost of operations by making a business. I think another important thing which RBI has done in this area is the video-based KYC. What it does is to kind of reduce the variable cost. So you have things that reduce the fixed cost. This reduces the variable cost of onboarding or acquiring a new customer. So the idea is that regulatorily, what all can be done to reduce operating expense or what you call fixed cost. Some of the things RBI has tried to, and leveraging largely on this. And this has also been kind of coupled with important developments in the payment system. For example, the NEFT, even the RTGS system, the IMPS, they are all available on a 24-hour basis. So this is again an important development. So coming as it does again, leveraging on the so developments. These are very important developments that we should understand. Now, I want to also kind of mention that where does this opportunity come from in kind of a nutshell? Is that there is the scope of competition, technology-driven processes are being encouraged, and then huge untapped market as I talked of, and very interestingly, see, innovation is very important in the financial services because one, it kind of reaches services to more people, it brings in efficiency. Two things RBS try to do leverage on this. One, account aggregator system, for instance. The account aggregator system, it's my interpretation that it is an Indian version, if you might say, of open banking without the risks of data privacy, which open banking system brings to fore. So that's kind of our answer. So it's a consent-based architecture which allows for collection and dissemination of information with the consent of the person whose data it is. So there's work happening on that. And then the other thing that in terms of development that has happened is the regulator supported innovation. So as I said, innovation is very important, but regulation can constrain innovation. So I think the whole concept of a regulatory sandbox where innovation is permitted under an a test conditions, as one would call it. Okay, and the first cohort has already happened. So I think, and I think the second process has started. So the regulator supported kind of innovation to improve the reach of financial services are among the things that I believe are happening in the country. That provides an opportunity and opportunity to invest in the BFSI sector, at least the sector that I'm talking of in regulatory space, and also makes it exciting to be there. That's, I think, for me. And then did mention about the possibility of what the NPS are. There could be risk of higher NPS. That's been a problem. We thought that the IBC did well in the initial stages. There are, of course, some concerns coming out now in terms of what has been the recovery to claim ratio in some of the cases that needs to be kind of addressed. But I think as a beginner, somebody is beginning, a lot of those things can be addressed through better risk management systems. So many of them, the question of legal framework being adequate, inadequate comes only when risk management systems are not able to prevent them in the first place. So I think someone who's starting afresh, if you're beginning in fresh capital, one of the ways to look at it is how does one put in place, and with technology, and I can tell you the credit information system in India today, both with the credit information companies with regard to individuals, the data which RBI has which the lending bank can access. Okay. I think the information asymmetry which one had absolutely virtually not there. So what one is actually able to take more informed decisions today than was able to do. And I think again I have also written this in my remarks. The government's thought process of privatizing a couple of public sector banks also provides, an excitable opportunity, if I may say, for people in that space. Because look, the banks, at least what are being mentioned in the public space today, are fairly mature banks. They are mid-sized banks. So it's not, a small bank. They may not be, obviously, it won't be the largest bank, but they're pretty decent-sized banks, which whoever acquires it will have it and develop it further. So I think I therefore want to say that there's so much of opportunity in terms of this regulator and authorities encouraging the technological developments that are there, fostering further technological developments in that area. Yes, no return comes without risk. Okay, so but understand the risk, and there are possibilities of better managing risk today than possibly was the case. I think that is what I want to say in my remarks. Thanks for that.
Thank you so much, sir. I think that was very, very well put. And you're right. I think the India digital stack as a whole, and particularly the BFSI leveraging of that, RBI's leveraging of that, has been absolutely phenomenal. Something that we should be proud of as a country. The tech, the architecture is, I think, fantastic. State of the art in many ways. We lead the world in many ways. Some of the concepts like consent-based access, addressing privacy issues, I think is absolutely spot on as well. And regulatory supported innovation, sandbox, etc. I think it works very well. I like the way you put the NPA issue. There is a legacy problem, but at least for prospective people, hopefully the architecture is there now to take care of those issues. I'm still going to send some dirty questions your way later on after we've heard the other panelists. For instance, while clearly ease of doing business has improved for people like you and me who use banking, borrowers would argue that all of this has not translated into lower credit costs for them. And the spread between where the risk-free rates are and where their rates are still pretty high. You mentioned that there is open licensing now, but there are lots of industrial houses which would like to see access for them as well as far as banking is concerned. We know your views on this, but I would like to hear it again. And finally, overseas investors also, I've heard a lot of them grumbling that they would like to do a lot more as far as distressed debt is concerned or other investments are concerned, and somehow we don't seem to make life easy for them. At least that's their perspective. But we'll come back to your question to these, sir, and I'll torture you with these questions. In the meantime, I'm going to go to Abhizar. Now we've got fantastic practitioners with us, advisors, investors, people who invest their corporate money, their investment, their institutions' money as well as their own money. I'm going to start with you, Abhizar. Again, somebody who needs absolutely no introduction at all. He's the head of financial services at EY. He's the go-to person for anything on India BFSI, and it doesn't matter what it is. And frankly, all the big deals which have happened in the past on BFSI India probably has his fingerprint somewhere or the other. Amazing experience and the go-to guy, frankly, for everybody, whether it's the government of India, whether it's RBI, whether it's MCA, industry bodies, etc. So, Abhizar, it's a real privilege to have you here. Again, you're a person who knows this space inside out. I'm not going to presume to dictate to you as to what you should say. The floor is yours, sir. Tell us what you think about this topic.
Thanks, Anand. I will take the next 5 or 7 minutes to talk about what I want to say. Primarily, Mr. Vishwanathan just said everything that India has done in terms of the infrastructure that is required for digital banking going forward. And I think it's spot on, and India has been the best. I have seen payment systems overseas which are much less efficient and much less slower than what the Indian payment systems are. I think we are possibly one of the best. Having said that, what needs to really change over time is the mindset of our banking system. So, if I look at the ABCD of banking as it existed, or rather as it exists now, it's basically A is for availability of credit. As you rightly said, not too many people get it even today at the right price. 2 is banking was just banking. It was a question of accepting deposits and giving out loans. And that's how we defined banking as far as we were concerned. The other thing was, as far as banking was concerned, it was primarily credit. So the C is the credit, B is the banking. And the D, which is very unique to India, was deposits. And we thrived on the fact that we had low-cost deposits. And everybody who wanted a banking license wanted it because it gave them access to low-cost deposits. CASA is really not what international banking is about. So what is banking, or what's the future of banking? The A stands for access. How easy are you providing access to people? The B stands for banking moves to business enablement. How are you enabling e-commerce? How are you enabling the ability to provide credit, the ability to use credit, and the ability to leverage credit for consumption? That's business enablement. The C from credit has moved to customer. What is your customer all about and how are you dealing with the customer? And deposits, frankly, which was the boon of every banking company, is now data. So the ABCD of banking is now access, business enablement, customer, and data. Now, if you look at this, what mindset we need to bring about is, as has been said by Bill Gates, I think, that banking shall remain, banks may not. And that is the reality. What I'm really waiting for is the farm easy moment in banking, where a 4-year-old startup acquires a 70-year-old diagnostic company. I'm really waiting for some startup to acquire one of our public sector banks, and convert that into a neobank. Because neobank is the future, data is the future, technology is the future, and we have to figure out that deposit basis will bring us loyalty, but beyond the point, an educated depositor will find better avenues of making money. And you will have to find better avenues of having access to finance and enablement to give better credit. So if you have the data, your ability to make existing customers who are not bank worthy, make them bank worthy. And I give this famous example to everybody. There's me and my friend, and I work for Ernst & Young and get a salary slip every month rather. It's very easy for anybody to figure out what I make and how credit worthy I am. But my friend is a businessman who possibly does not disclose all of his income, but has the same consumer habits as me, goes to the same restaurants, buys the same clothes, does everything identical to me. His surrogate income can be established to be equal to that of mine. And though he is not creditworthy today because he does not have a balance sheet, will suddenly become creditworthy because of the habits that he has. And that is data. And if we are able to make more and more of India creditworthy through surrogate measures, that is when data will succeed. And that is where banking will succeed. And that is where, Anand, as you said, your spreads will narrow. Because the credit risk will be better managed, will be better understood, and hence managed. Now, coming to the second part, will there be defaults? Yes, there will be defaults. Managing defaults upfront is something that a mindset we need to change in ourselves. Most of the flack that we're getting today is because we have languished over those assets for 10 to 15 years, or maybe 5 to 6 years, not doing anything about it. And then suddenly we say, oh, we get a 20% recovery or a 5% recovery. Those assets are worth a 5% recovery today. But possibly 4 years back, they were worth 50% recovery. And had those been handled 4 years back, we would have got those 50% recoveries. So really, stress, first of all, we've now acknowledged, thanks to IBC, that stress is a reality. And it does happen in the banking system. It's the cost of doing business. And we have now had mechanisms in place to deal with that stress more effectively. And I think the sooner we deal with that stress with the existing mechanisms, the better recoveries we will get. So we need to get to a culture to say credit loss is acceptable. Let's deal with it to maximize the recoveries. And that's how we could deal with stressed assets. Coming to the last part, do we need to rationalize the banking system? We've got a large 70% plus PSU banking system. It need not be there. And we've started the process by doing some level of consolidation. And then there are now the unconsolidated, so to say, banks, which could be put out in the public for sale. And I personally think that corporates are, and I'll stick my lip out to this, corporates are not a bad option in terms of acquiring banks, though we've heard otherwise from experts. And I say this very fondly, that people have said that, the intellectuals kept debating, the fool went and did it. And I think if you apply that principle, you will actually find that if you give licenses to people who have demonstrated good credit over years, and we have corporates who run large-scale NBFC businesses, possibly bigger than some banks, and they have run them very successfully, very ethically, and if they run them very ethically, there is no reason why they can't get a banking license. And I think if we do that, the sources, the holders of capital in this country are the corporates and large-scale domestic capital. And if we want to use them, I think it's a good way of actually getting privatization through with allowing corporates to get into banking. I'll stop there and wait for your tough questions as we go on, Anand, so that others can have enough time to express what they have.
No, thanks a lot, Abhizar. I'm tempted to give you 3 minutes more, given I was just engrossed taking notes. So thank you. But yeah, we will come with some dirty questions to you as well. You're absolutely right about, if people I love the point about farm easy moment in banking. I'm waiting for that too. But I'm wondering really, if pharma is different. Banking is highly regulated. In a environment like this, will a farm easy moment really happen? Is a question I would have. And you're right about IBC having changed the mentality about at least ongoing stress and prospective stress. My question is, the overhang that we have, including the stuff which we still don't know about, is enough being done for addressing that, or is that not an issue? We'll just forget about it and it'll resolve by itself. And of course, on the corporate issue, I'm hoping that between you and Mr. Vishwanathan, we can have a Arnab Goswami kind of a debate. But we'll come to that eventually later. I'm now going to head towards Narendra Oswal. Narendra, lovely seeing you out here. Narendra is the managing director of Warburg Pincus. He puts his money where my mouth is. I'm just an armchair professor. He looks at all investments in financial services and healthcare. He's been in Warburg Pincus for 14 years now, and prior to this, he was in McKinsey and in 3i as well. He's a chartered accountant and a grad from IIM Bangalore. So welcome, Narendra. I'm presuming you're going to give us a private equity investor's perspective. But the floor is yours. Tell us what you think about investing in India BFSI.
Thank you. Thank you very much, Anant, and good afternoon, everyone. First of all, I'd like to, of course, thank the organizers for giving me this opportunity. Again, having, sitting alongside a panel with, Mr. Vishwanath and of course, Abhizar and others, it is quite a heartening moment. I would say we are gathered here today at a very interesting point in time where the economy is, sideways, let's say, where the markets are on steroids, and where the banking and the NBFC industry is, right, which is, I would say, at a crossroads. And the reason I say at a crossroads is because there are, of course, challenges that the industry has to face thanks to COVID. But also there is a massive opportunity given what technology has brought to the table. And, some of these things Mr. Vishwanathan covered and Abhizar as well covered. Now, as a private equity practitioner, we are both outsiders and insiders in this industry. Outsiders because it's, of course, we are just investors. We are not operators, but insiders because we have the vantage point of investing behind several institutions within the whole ecosystem and, have a little bit of that insider perspective. And I hope to at least over the next, call it, few minutes, give a little bit of a bird's eye view of how we see the various trends play out and where is it that we are focused as private equity. And, in the least, I would put a third pillar between Mr. Vishwanathan and Abhizar that, if there is inconclusiveness in the debate on corporates, private equity is one legitimate option to, buy banks and turn them around and grow them. Overall, I would say we see immense potential. And that private equity can clearly play a significant role. And this is not just a futuristic view. If you look at the last 2 or 3 years, almost a quarter of the dollars that have been invested in private equity are going towards financial services, more broadly defined, including payments, including, the whole gamut of BFSI. So this has been a sector that has been a mainstay, and at least in my vantage point, I continue to believe will be one that remains over the next several years. And why do I say so? I am seeing 4 broad trends that create meaningful opportunity for us. First, I would say is really the meta trend, and the meta trend is really around growth in the ecosystem, accentuated by share gain. And this share gain in several segments is being led by private banks, SBI, of course, which, in many ways is operating equally so, and NBFCs. And this trend is playing out, of course, in the credit business, but also on the insurance and some of the non-credit businesses. And this has been, I would say, a trend that we have played for the last decade as we've invested in NBFCs, HFCs, MFIs, banks, small finance banks, life insurance and general insurance. I'm talking about us as a firm. But as I look out the next 10 years, I continue to believe this can remain a big mainstay thesis for us. The core challenge or the core issue from our perspective in this whole trend is really finding out the business model that can survive and grow alongside really large institutions who are constantly eroding NBFC territory. If I remember the first time when we had invested alongside Vaidya at Capital First, there were a certain set of segments Capital First was good at. That had to change because the private banks are constantly eroding territory. If you're in affordable housing today, you have to take a 5-10 year view to say, look, what will be the line that banks will draw? Not today, but 5 years from now, when technology is going to deepen for them, when data is becoming more easily accessible to them. And I think that's really the core challenge for us as we think about our investing strategy behind this trend. The second trend is really a near-term one. This is around asset quality challenges that the industry is faced and facing. Mr. Viswanathan also talked about the whole NPA cycle, and I think there is possibility that we may see another one depending on how COVID plays out. So far, I would say the system has really dealt with the COVID blow very well, but I do believe that COVID will still accelerate equity needs. So while people may have absorbed all the losses and may actually be solvent, and thanks to a set of actions RBI took, not now, but call it 3-4 years in making, between IBC, between forcing stress, between raising capital needs, forcing ecosystem participants to consolidate. I still think that there will be a need for more capital. The private banks and the larger ones have already done their round of capital raising in the last 12 months, but I would say a large swath of NBFCs have still not done so. And that, while is a challenge that NBFCs have to deal with, in my mind, I also see it as an opportunity for private equity to participate in some of that capital raising issue. I think the core challenge for us is really to identify businesses that can withstand stress. So even though the metrics we see today aren't particularly great and aren't particularly robust, but can we look through the near term and believe that the team that we back or the platform that we back will really stand the test of time. We did housing finance while in the midst of the pandemic last year. We had done microfinance a year after demonetization. And I think we have the capacity to take a long view, but it's still a call, right? It's still a judgment call one has to make. The third is, of course, our stake in the ground on privatization. We think private equity can play a role, and I think we personally see it as a huge opportunity. I think the core issue here really is regulatory. What is the extent of economic ownership and governance control an owner would get, through the privatization process? And I think that will really drive the success of that initiative. I think if we set it up right, it will succeed. And if we don't set it up right, I think it will end up being sluggish. And the last one is, of course, technology. This is an all-pervasive trend. Technology is becoming core, not just for startups, but also traditional businesses who are adopting them. While this trend throws several opportunities at us, it also makes us pause because we do have a large traditional portfolio. To Avizar's point, right? If things ended up changing dramatically in terms of the participants in the ecosystem, a lot of the stuff that we have done over the last 5 years, one will have to pause and say, look, what's the future? We remain believers that technology will benefit not just the newcomers and the disruptors, but also existing incumbents. It's really the mindset that management teams take to embrace technology and really fortify their business. And that's the type of skill or talent we are looking for when we are looking at things. As private equity firms, we of course participate across the ecosystem into newer firms as well as older firms. But I think that's the lens. And I know we have Ishan on the panel who can talk, of course, a lot more around technology. They do this for a living more than we do as private equity firms. But I will say it is still front and center of everything that we do in terms of our evaluation. So in conclusion, again, not taking too much time, I do believe this is a secular growth opportunity in the sector. Opportunities created by conditions as well as technology, I think, suit us well and provide a deep set of opportunities which we hope to continue to participate in.
Hey, thanks a lot. And that was fantastic. Very cogent, totally with you. Would love to understand a little more on the point you made about, first of all, I'd love to understand your secret sauce. How do you actually, you talked about, finding the separating the winners and the not real winners. I would love to hear a little more about how you go about doing that in today's muddled world. You talked about regulatory issues being key as far as private equity investments are concerned. I would love to hear specifically what is it that you think is required, and both from the government or from SEBI, RBI, whoever, which would give you that clarity. And yes, absolutely, we will come to Ishan and then get him and squeeze him a lot more on the technology front. But great points there as well. But before Ishan, I'm going to come to Biswanathji. Biswanathji, welcome. Great to see you again. And very quickly, as an introduction, Biswanath Patnaik is an entrepreneur and a private equity investor. He puts his own money into various investments. He's also a banker. He holds a law degree, and he essentially runs BNP Investment Company, one of the sponsors of today's program. So thank you, Biswanathji. Appreciate that. And he's got investments in London, Hong Kong, and Singapore. Biswanathji, the floor is yours. Your take of investments into India, particularly into the BFSI sector.
Thank you, Anandji. Good afternoon, everyone. I would begin by thanking Sri Rajiv Poddar, President IMC, Sri Arijit Basu, Chairman Banking Committee, Sri Ajit Mangulkar, Director General IMC. Indeed, a great honor for me to be part of this distinguished panel today. And thank you, IMC, once again to invite me to be part of this flagship program for the second year after 2019. I'll give a small brief about myself, then I'll open my opening comments. And as a self-made first-generation entrepreneur, now an NRI from a very middle-class family from Bhubaneswar, a professional banker, lawyer, and after going overseas, a financial investor now. Today, I have investments in UK, Dubai, Singapore, and Poland. I'm not involved in a day-to-day management of the investee companies, but I provide strategic direction and contribute to the growth and performance review. Also made a start in Africa and Eastern Europe. All investments are with my own funds. No funds are of others, or no borrowings, no leverage. My funds are fully compliant with all local laws performed by an established law firm in UK. And I use service providers of the highest reputation and quality. And these opening comments will be as a overseas investor's perspective. I represent the new aspirational India, which has started emerging over the last decade, which has been strongly encouraged by our Honorable PM. However, success has come outside India, not in India, except for a few unicorns. For every successful startup, there are 10 failures. So as an NRI, I would request some special consideration. We are not taking money out of India. We are bringing money made outside into India. The source and color of money is known and clear. The official system, government, tax, regulatory authorities are politely suspicious of us. Today, there are well-established systems of KYC, UBO, AML, common reporting standard, financial action task force, which should enable the authorities to differentiate between honest investors and crooked businessmen. Notwithstanding all the beautiful and motivating speeches of our Honorable Prime Minister, there is no doubt that he has been successful single-handed in projecting India as a land of opportunity, high-skilled, low-cost human talent, expanding market for most products. However, all this good feeling evaporates when the investor deals with RBI income tax, GST, MCA, and other regulators. So I have a very few specific suggestions to make based on my personal experience. Some of these may have been already acted upon. If so, I am happy to be informed and corrected. The onboarding process of FPI, Foreign Venture Capital Investor, FVCI, is too cumbersome and time consuming. No other foreign investment seeking country has such an elaborate system. An investor has to incur substantial fees to his professional advisors like CAs, lawyers in India and abroad. So is it worth it? We have to remember that India is a capital deficit country, particularly risk capital. Need a special window and fast track for NRIs. I would suggest that the registration and approval extra can be delegated by SEBI, RBI to BSC and NSE. If necessary, they can form separate subsidiaries. The GIFT City in Ahmedabad and the International Finance Center, IFC, is an excellent concept. And I'm informed that an exclusive regulatory framework for IFC is under development. I have also invested in some real estate there, but it is necessary to set up a IFC in other cities as well, like Navi Mumbai, Bengaluru, Noida, and in my eastern hometown, Bhubaneswar. The concept of overseas corporate bodies, majority owned by NRIs, which has been abolished about a decade back, mainly due to tax evasion fears, may be revived. OCB mechanism gives a lot of flexibility to NRI investors and allows them to get foreign non-NRIs to co-invest with them. With the improved surveillance framework in place now, regulatory concerns can be addressed. So there are extremely rich family offices abroad who have huge investable funds who want to participate in Indian growth story. Some of them would like to start by being a lender initially, followed by portfolio and later direct investment. They are deterred by regulatory administration. So I suggest that family offices with a minimum investable funds of USD 1 billion and registered with local authorities constituted as a private company or registered with the local authorities to Indian companies as ECBs. Today, only banks, financial institutions, AIFs regulated by financial regulators are allowed to lend. These loans can be cheaper than bank loans as the overheads are much less. In fact, I would propose that no approval should be required for an Indian entity to contact an exchange board of average maturity of 7 years and above, which for an amortizing loan would mean a door-to-door maturity of 12 years and above. These are my concluding comments. Thank you so much.
Thank you, Vishwanath ji. And you've given a lot of suggestions. Some of them I think have already been implemented, to be honest. In fact, SEBI and RBI have been working on this, including things like delegation of onboarding, etc. I think it's already been done. But I will let the other panelists also jump in on this. But thank you for your comments. I'm not going to come last, but definitely not the least, to Ishan. Ishan is wearing his uniform, by the way. This is how he's dressed when he's talking to his investors, as Narendra was mentioning. He's a tech-savvy guy. He's a principal with Sequoia Capital, again, deploying money into this country. He is a BTech from IIT Delhi, and he has an MBA from Harvard Business School. So watch this guy. He's going to be the guy with the big bucks. Ishan, the floor is yours. Your takeaways. I'm sure you're going to speak about technology, but otherwise, anything about investing in BFSI in India, all yours.
Thank you, Anand. I definitely had to wear a little more formal wear to join the panel. No, thank you so much for this opportunity. I think we as Sequoia Capital, like Narendra mentioned, also are very heavily invested in the financial services space overall, not just right now, but for many years in the past as well. So we started from a lot of MFI investments and then NBFC investments, and more recently have doubled down a lot more on the fintech and payment space, just like we have in US and China. I think what we are seeing is that as India is becoming a larger and larger economy, the consumer needs for financial products is both growing and changing. I think that is the secular trend behind which we are investing. We're typically minority investors, so we are looking at founders who are coming up and saying that, hey, I see a white space on how the consumption of financial products is changing, either from a merchant's perspective or from a consumer's perspective. And wherever we see that white space, we are going to build a business using technology, and we are in the business of saying, hey, we believe in you, we are going to back you to do that. So I think what we are seeing is that, if we think 10, 15, 20 years ago, the banks used to be, or the traditional institutions used to be the single point of contact for a consumer for all financial needs, right? Starting from your savings account to your loan, to your insurance, broking, anything under the sun, right? And in the last 5 years, what we have seen is just the disintegration of this use case, where more and more companies are specializing in coming up with a single case and saying, hey, you want to do investments? I am Zerodha, I am Grow, and use me because I provide a differentiated experience. Or if you want to do payments, consumer payments, I am PhonePe, I am Google Pay, I am Paytm. And similarly, we are seeing that for multiple cases. And there we believe and we have the conviction that the younger founders are able to redefine the way the solutions are provided to the consumers. That said, none of this is happening in isolation, or none of this is happening because they are just much better than the established institutions like banks and NBFCs. I think it's happening because they are able to collaborate very well. So most of the companies I've talked about are one side of the coin, and the other side of the coin are the banks and the traditional NBFCs who bring in different expertise. The tech companies are bringing tech and product, and the traditional institutions are bringing balance sheet, their understanding of credit underwriting, their strength of collections. And I think we are finding it that collaboration is really what is creating value. I mean, very recently, Vizar mentioned about his wait for the moment, the Farm Easy moment. I mean, we felt very good when the regulators were extremely supportive of the Bharat Pay and Centrum acquisition of PMC, and we felt that was a pretty historic moment, right? So we are finding that collaboration extremely helpful. And what is the second thing that is helping is, and many people have mentioned this, but I would like to double click on that, is just the phenomenal innovation the regulators have done. I mean, India is by far ahead of any other country in terms of just the financial institutions innovation, whether that be NPCI or the overall India stack, video KYC. And that is really what is providing wins to the sales of these startups, because they are able to do what they imagine, right? Otherwise, if all the stack didn't exist, you can have all the distribution in the world, but how will you onboard a customer a few hundred miles away if you didn't have the India stack, if you didn't have all these KYC innovations, right? So I think that has been a very positive tailwind for all these companies. I think lastly, I think the way we see it is that we're investors across the globe in financial service and payments. We have seen more than $1 trillion of market cap get created in last 10 years, including companies like Stripe, Ant Financials, Nubank, Revolut. Most of these companies we are investors in, and what they have done is, as I said, they picked up a single use case, gone very deep in it, partnered with the traditional institutions, and just completely changed the way business is done. And in the next 5-10 years, we expect something similar to happen in India, and we're just backing the trend.
Excellent, and more power to you, and Godspeed on that, Ishan. For our sake, I hope you're successful. But it sounds like you're essentially echoing what Mr. Vishwanathan said about the potential that the India's digital stack offers to the entire ecosystem. And from what at least I heard, you don't really have a wish list as such. I think things are in place. You're just waiting for things to fall in place, and then we follow the China example and monetize. So great, Narendra. Before I go to Mr. Vishwanathan and Avizar, I'm going to come to you on a couple of questions. So one is, of course, the point I mentioned to you about picking the winners and losers. If you can give us some, what is it that you look for when you're looking at banks or NBFCs who you think will do well? And the second part, you mentioned this regulatory part. So before I go to Mr. Vishwanathan, any specific asks, because Mr. Vishwanath Patnaik has given a whole list of things that he would like to see done. Ishan is extremely happy, but from your perspective, anything that you think needs to be done?
So on the first question, Anant, I'd say the simple answer, again, may seem motherhood apple pie, but it's people. I think for us, the market opportunity is there for several participants to benefit from. The share shift is, again, a trend that is, anybody could potentially back. And I think the real experience we've had, the differentiating factors are really people. I think there are entrepreneurs who have the capacity to attract the right talent, build the right processes, be, I would say, focused on execution. And those have been the winning qualities, at least if I look back the last 10 years and several of the things that we have done. On your second question on regulation, I would say there are really two aspects that I think are worth considering. And one I would say in the banking side and the other in the insurance side. So the simpler one first, the insurance side is, there is an expectation that if strategics invest in insurance companies, they can do it directly. But if it were a private equity firm that were to want to invest in an insurance company, there is a what we think an artificial need of having to put up an SPV holding company in India. And as we all know, that is massive administrative complexity, massive commercial leakage, because you can never list a holding company, you'll have to list the operating company. And then how do you, as an investor whose business model is to exit, at some point we have to sell our shares and get the money back to our investors. I think that whole structure itself creates massive complexity. On the banking side, I would say the regulatory architecture in general, really two things. One is I now know that this is a matter under consideration, but why could not private equity firms own more than 10%? Could it not be 15 or could it not be even 25, right? With the right checks and balances in place in terms of governance, which already exist, I think that's I know a matter of hot debate at the RBI, but that would be sort of one consideration. Two, and a more interesting one is in the context of privatization, the traditional current regulatory architecture which limit ownership to 10% and does not give you governance control, we believe is insufficient if you had to do all the things you had to do once you take over a bank and really pivot it and grow it. I think we need degrees of freedom in terms of governance and commensurate ownership, right? To be able to then bring new management in place, as an example. Make the right investments which are for the long term, for an example. And the more fractured ownership you have, the more tough it is to build consensus around the turnaround or the material growth that one would want to bring about in an enterprise that you take over. And I would say that's the setup. If you set it up right, give the right extent of ownership and the right degrees of freedom to an owner, the privatization initiative will be a lot more interesting for us, and I would also genuinely believe a lot more impactful post facto.
Thanks a lot, man. Very articulate. Vishwadhan sir, I'm very conscious of the time, but I'm going to come to you next. You heard a lot of comments which refer to the regulatory context. I'm not going to repeat them. I would love to hear your reaction to some of the issues which came up. Very broadly, sir, and spoke to him yesterday, he used a very nice term. He said there is this polite regulatory suspicion about investors coming in from overseas. So my point is, I know you're in a tough space. BFSI is not a space that you can leave unchecked. At the same time, do you believe you're running the right checks and balances and right balance in letting our fears take over and allowing innovation and change to happen? That would be the generic question, but I would let you answer in which way you deem fit, sir. Sir, you're muted, please.
Yeah. So on the whole issue of ownership, control, and that, but I also will tread into what a basis head on corporates owning banks. There isn't one simple rule which is, you can't say what is right, what is wrong. Okay, but what you must look at is what is right in the context of the country, what is right in the context of the regulatory framework in the country, what is right in the context of what is available in the country. So I'll begin with the point on corporate side, because you said my views are known. The three comments that I want to make that. Number one is that irrespective of how one runs a real economy entity, how one runs an NBFC, okay, the bank license is an entirely different kettle. Which is why if you look at world over, even the freest of economies, banking business is licensed. Okay? It's not free. It's not an entry and exit game. Free entry and exit game. Second is that if you look at what the I think the Pannai committee had talked of, the committee of hard working, they talked in terms of licensing, allowing corporates to own banks, but after making amendments to law, after making sure that they have the capability. The problem with the banking system, many times you cannot, you cannot end up in a situation where you close the stable after the horse is on. So it's very many times you might get there, but it could be a little too late. Number one. There are also, if you look at even in the NBFC space, there are what was supposed to be great entities. We have found what have happened in some of them. So and the second part is, I think, on what Mr. Bessie said, and that's again the recommendations of the committee, that corporates which are owning NBFCs should make them a fast track. But for me, I would say that whether it is the root shouldn't matter. Who is the owner should matter. So, and then you are giving a comparative advantage to a corporate that has an NBFC opposed to a corporate that doesn't have an NBFC. I think, therefore, in my opinion, that cannot be separated. So I think the view whether corporate should be allowed or not, and taken first, and then you go through NBFC, do not go through NBFC second. Okay. The third part is, if you look at the in terms of the data that we have, the 2013 licensing guidelines, many corporates applied. So there was no bar on corporates applying for bank license. It went through a detailed scrutiny process. Ultimately, the external screening committee just recommended 2 entities which were already in the BFSI. One was so there are and some of the officers which applied withdrew. Many which applied did not make it. So we don't know. So there are very many factors which one must be guarded. The other argument for which again I also seconded is that they are the owners of capital. Okay. So the point which we must understand is when there is stress in the economy, their own real economy entities also undergo stress. So who are the guys going for a bank restructuring? The real economy guys, they are not putting their capital there as much as is required. Okay. So you do not want a group who is stressed because of economic problem to also run the bank and then create stress there. So I'm not saying. So what I'm saying is it's not a kind of a open and shut kind of a case that that's where the capital is to allow it. So a lot more. So if you're going to change, there's a particular position. If you're going to, you must have a lot more arguments why you should say that what we have today. I think that's the way I then on a larger point of ownership, I think if you look at the current framework is in terms of the approach of RBI has been to prefer a dispersed ownership. That's it, and allow the bank to be run on a professional basis. But in the initial period of licensing, the promoter is supposed to have a stake, which the promoter has to retain at least for 5 years up to 40%. So what we are saying is we want the promoter's stake at the beginning. It must be dissipated, over a period of time. Current regulation that it must be dissipated up to 15%. The recommendation that has come from the business. So and you also have the other point that the law says the outermost limit in terms of voting rights is 26%. Irrespective of how much you hold, the 26% voting rights outer limit will also. So obviously, when the privatization of the publicly the banks have been taken up, these are the issues that will come up. Obviously, there will be strategic how the actual privatization will take, what would it take, will be an IPO, will be strategic investor, those are still matters not known. But I remember the governors have been saying that RBI will definitely want to look at whoever is coming in, whether he actually, whether the person acquiring is fit and proper, and whether the person who's acquiring has financial muscle to run the bank. Because I've told this in the past, and I've told now also these are mid-sized banks, they're not small banks. And without the safety of being run by the government, it is a lot more vulnerable to liquidity constraint when there's even this small fear of solvency being questioned, and therefore the promoter should be one who can that confidence. See the fundamental point again, I think everything made about depositors. Let's be very clear. Globally also, the move is that to reduce the reliance on bulk deposits. What it means is the global, even the Basel principles kind of look at a lower runoff rates for retail deposits. So the retail deposits are what will keep the liquidity flow into a bank, coming, and that has to be stable. So depositor confidence is very crucial to the running of business. So if somebody acquires or somebody wants to invest in an existing bank, when we look at the depositor franchise, kind of stability is there in the deposit franchise at the bank is something that we look at. Otherwise, it becomes an NBFC. And last, I think this is again mentioned about data. So if you look at, I did mention about, for example, today, the credit information bureaus are even supposed to have information about who are members of an SHG. So today, if an SHG has borrowed, there are 20 members of the SHG. The internal defaults of the SHG members are not known. These A, B, C, D, E, F are the members of this SHG which has borrowed is known. So that a bank or an NBFC or MFA which wants to lend to somebody in that SHG he will know that this person is already a. And I think I also forgot to mention this, but I think the current approach of RBI to harmonize this entire MFI framework, making it more activity based rather than entity based. I think it provides a lot of opportunities there in a way for people to enter that business, but as an activity that regulated only different. Overall, therefore, the use of technology and the ability to use technology is something that has substantially improved. And there, I think Ishan mentioned about collaboration. The fintech, so the role of fintech, what's happening, what is shift fintech? Fintech is not a financial company, and therefore there's a limit. So in the past, banks used to see the fintechs as a competitor. Now it has to be seen as a collaborator, and that is where the parsing of where they want to be in that space has become very important, and therefore creating that what do you call and also creating a regulatory architecture through the sandbox for them to function in a manner that where innovation and regulation can meet. I think.
No, thanks a lot, sir. That was very, very comprehensive. Again, I'm very conscious of the time. I can see Zareen is here and she's waiting patiently to start the next session. I am, however, going to give Abizar, Bishwanath as well as Ishan very quick closing comments. I'm sorry I couldn't send the questions across to you, but Abizar, let's start with you. Please react to whatever you've heard, plus some of the questions which I put up to you earlier, and your closing comments, please.
Yeah, so I don't want to repeat anything on the technology and the way forward banking, which you already done. I would just like to talk about stressed assets. It's a topic which is very close to me of late, and I would like to certainly talk about it. So I agree that we can't stack away the problem. You raised the question: can we stack away the past debts and into something else? I think we're forming this bad bank or the NARCL. I think that's a good initiative, provided that we are really dealing with aged NPLs in that entity or in that SPV. What we really need to do is find more innovative ways of recovery than traditional ways of recovery, because we've been doing for the last 4 to 5 years traditional ways of recovery. There's the IBC and there is the any other security enforcement and SARFACI and everything else. We need to move away from that and basically talk about how can we reinstate enterprise value in some of these distresses. So there are assets which have core value in them, which today languish because of a bad capital structure. We need to correct that capital structure. If that means that banks need to take a haircut, if that means bank needs to convert debt into equity, if that means incremental finance needs to come in, we need to do all of that and revive the enterprise value of the company to enhance it. And I think that is the approach required for the next. We're talking about 4 lakh crores. And even at 20% recovery, that's a hell of a lot of money. So I think there is some innovation required in doing that. There are ways and methods of doing it. As I said, enterprise value, people like Narendra or Ishan would know that very well. You would know that very well, Anand, yourself. So I think ideally one would need to make sure that the enterprise value goes up and focus on those methods of turnaround as against simply focusing on traditional methods. I'll stop there. And as you said, people are waiting, so I'll move on. You can move on.
Bishwanath, we are absolutely out of time, but I'm going to allow you to say a few parting words. Actually, we've eaten up into the next panel's time as well. But Bishwanath, please go ahead, and very, very short comments. You're on mute, sir.
So quickly, as an NRI financial investor, so far I have restricted myself to investing in financial markets overseas. But I am now turning to the BFSI sector, NBFC, AIF, even possibly banking, as it seems to be opening up. So I do see a huge opportunities in this sector if properly targeted. The thrust has to be on mass products. So I'm also quite impressed with the development of the financial market infrastructure in recent years. However, I do feel that the procedures and formalities need to be simplified without relaxing the regulatory rigorness. Technology should be used for unobtrusive surveillance rather than in-face scrutiny. So I have a few specific suggestions in this regard, which time permitting, I will share them. Apart from the regulatory hurdles and procedural hassles, the possibility of strategy risk, by this I mean a wrong strategy, if it fails, turnaround is very difficult. So once dubbed a failure, it is not easy to rebound in a financial service, unlike the Indian sector. Thank you so much.
Thank you very much. And what a lovely note to end on. It is a positive note. The more opportunities than risks as far as BFSI is concerned. I owe an apology to Zareen. She's my former boss. I'll send her a box of chocolates. But this has been a fantastic panel. Vishwanath sir, Vishwanath ji, Abhisar, and Narendra. A lot of rich takings away. We will summarize this and certainly follow up on this. Thank you very much for your time. And back to you, Mansi. Thank you.
Thank you. Bye.
Thank you. Thank you.
So a special thanks to our guest of honor, Mr. Vishwanathan, and our expert panelists, Mr. Ostawal, Mr. Devanji, Mr. Mittal, Mr. Patnaik, and of course our moderator, Mr. Narayan. Thank you all. We move very quickly to our next session, which is on future of technology and sustainability in banking and financial services. This, ladies and gentlemen, is a fireside chat with Mr. Bill Winters, Group Chief Executive, Standard Chartered Bank, to be moderated by Mr. Zareen Daruwala, Co-Chair IMC Banking and Finance Committee and Cluster CEO India and South Asia markets, including Bangladesh, Nepal, and Sri Lanka, Standard Chartered Bank. Let me remind you that the agenda and profile of speakers are on the bottom right-hand corner of the screen. All those with questions are requested to submit their queries in Ask the Question section on the bottom left corner of the screen. Do specify the speaker's name to who the question is addressed to, and do not forget to click on the submit button after the question is typed in the Ask the Question section. So with that, I hand over charge of this fireside chat to Madam Daruwala.
Thank you, Mansi. So, Bill, a few questions from my side. To start with, before delving into how technology is reshaping the banking sector, perhaps we could discuss how technology is reshaping the Standard Chartered Bank strategy and how is the bank's experience unique?
First of all, it's a real pleasure to be here, and of course to be grilled by Zareen, who I get the private grilling from time to time. To get to do this in public is particularly exciting, and even Anand from the previous session commented with great respect at Zareen for what you've done at Standard Chartered Bank, and I will echo that. I'm also aware that I'm speaking to a group of people related to or inside the guts of the finance industry who are really very expert in some of the topics that we'll be discussing, in particular around technology and sustainability. So I hope that you'll take my comments in the context in which they're delivered, which is the perspectives of one person inside one bank around some of the opportunities and challenges that we face, rather than in any way suggesting that I'm going to tell you something that you don't already know, because I suspect that there are experts in this room that exceed my level of expertise substantially. But yeah, well, what is this? What is the technology evolving landscape meant for Standard Chartered? Just a touch of context. I joined the bank about 6 years ago. Zareen joined a bit after that, and I think what we found was some excellent cutting-edge technology in the bank, but that was not very well integrated. And I think part of the way that the bank had organized itself historically was sort of a central design unit, a central build unit, and a central operational unit, which was good for cross-fertilization of ideas between one application building and another, or one bit of infrastructure and another, and not good in terms of having a really strong connection to the business. And I think that the top philosophical, or call it strategic, objective that I've always had, recognizing the importance of technology to the banking business and virtually every part of the banking business, is to say to the business heads, obviously in our case, Zareen for our cluster of South Asian countries, anchored in India, you own your technology, you own the applications of that technology, and we'll centralize the development of resources to the extent that that's the most efficient and most effective way to do that. but the lead in terms of both the development of the requirements and then obviously the implementation has to be with the business itself. And in many cases, that has required a pretty fundamental retraining of our most senior managers. If you spent a lifetime in a bank not having to worry about technology, you sort of filled out a chit, slid it under the door of the technology department, got a program back 2.5 years later, may or may not have worked. You're not very familiar with the technology building process. That wasn't quite that bad at Standard Chartered, but it had a bit of that feel. I'd say now, every dollar that we spend on technology, we treat the same as we would spend a dollar on a salesperson or a trader or anything else. And for Standard Chartered, that's been a few key areas of focus for us. First and foremost has been on digitizing and automating everything that we do. We have substantially, but not completely, automated processes now for both our retail and our corporate bank, with an extensive list of internal APIs and quite a robust and growing list of externally facing APIs, but all with a view to improving customer satisfaction and delivering a more efficient set of products and services. In our retail business, which we operate across 26 markets, we've shrunk a few in the past 5 years, not much. We've had a very fragmented underlying infrastructure, so we've been taking steps to get some common platforms. So we're rolling out now common mobile banking platforms, common core banking systems, which were also fragmented. On the corporate side of our business, we've actually had a single set of underlying applications, of course, customized as appropriate for local usage. There's the question of getting us from the current state, which is a hybrid of automated and digitally initiated transactions, through to an overwhelmingly digitally initiated and then straight through processing flow. And that's involved a pretty substantial shift in our technical focus. But sorry, I'll stop there because obviously we could talk about this one question forever, and we don't want to do that.
What do you make of big tech companies entering financial services? Will this lead to greater client choice or greater risk?
First of all, I say good luck to them. When they can figure out the regulator, they'll let me know. But being serious, customers want convenience, and customers will get convenience, and customers deserve convenience. And in many cases, convenience means having seamless interaction between what they do outside of financial services and what they do inside financial services. And the only impediment to big tech penetrating financial services is the fact that the regulation and the regulatory requirements that come with that can be very, very heavy, not just on the financial services part of their business, but therefore on the rest of their business. And so I think we've not yet settled, neither the regulators nor the tech sector nor the banking sector have sort of settled on what the modus operandi is for competition or cooperation. Our approach is to do everything we can to give our customers that level of convenience, one way or the other. In some cases, that means creating the convenience platform inside Standard Chartered Bank, so creating that platform that the customers are comfortable plugging into. In other cases, that's a hybrid where, I'll give an example. In Indonesia, we've recently launched a banking as a service platform where we're delivering a full range of Standard Chartered banking services, deposits, loans, credit cards, foreign exchange, wealth, to be rolled out over time, through e-commerce platforms. And the partner that we are initiating this with is Bukalapak, largest e-commerce platform in Indonesia, 100 million customers, growing very quickly. They don't have a financial services offering specifically, not a banking offering. And they took the view that they wanted to offer the convenience of financial services on their e-commerce platform. We took the view that was a very effective distribution channel for us, and also a way to work together to develop the data sets that will allow us to make more informed decisions from a banking perspective, both from a credit products, but also in terms of other products and services to offer. So it's a hybrid model where we're working with a partner who provides the convenience alongside our products and services. And in other cases, we say we're just going to be a service provider into somebody else's platform. And whether that's the way that we're a loan purchaser off the Ant Financial platform in China, or a service provider to other big tech companies, the argument will always be, if you don't own the customer, you're not going to generate the profits and the margin. And that will be true to some extent. So you better be sure if your strategy is to deliver products through somebody else's convenience platform, that you are either differentiated in your product, which is hard to do in financial services, not impossible, or that you're an extremely low-cost producer. And so that's the way that we frame the issues, and we have come out at all points on that spectrum, and will continue to in the time to come.
Pivoting from technology towards another topic that is gripping all of us, sustainability. How is fighting climate change and the broader need for sustainable development changing financial services? How does this tie in for corporates from an ESG perspective?
I mean, this is a huge issue. And I mean, from our perspective in Standard Chartered, and I imagine many of you in the room have the same feeling, if we're not successful as a planet, as a race, mankind, if we're not successful in keeping the increase in temperatures below 1.5 degrees centigrade, the bulk of the cost and the bulk of the risk will be borne by us in India and beyond. So the developing markets or the less than fully developed markets simply don't have the financial resources to absorb the cost of very high temperatures and the reduction in livable habitats, the flooding that would follow from rising sea levels, etc. At Standard Chartered, I can tell you, operating across Africa and South Asia, ASEAN, the impact, the full impact of climate change would be felt very acutely by our clients in our markets, our colleagues, and would present a very substantial risk to us as a bank. So we recognize up front that this is a risk that we've got to manage to the greatest extent possible, and we always know the best form of management is prevention. The challenges in getting there are very many. I mean, first, we've got to have a will. There's got to be a commitment, and it's just been amazing to watch over the past years the number of countries and companies that have committed to make their own transition to net zero by 2050, so zero net carbon emission. Many of the people making those commitments have absolutely no idea how they're going to get there or what it will cost. And that, of course, should cause us all to be a bit nervous because it undermines our confidence that it's deliverable. But more and more, there is an understanding of what we need to do, quite precise. And I can tell you at Standard Chartered, we're delivering our transition plan publicly in October, November, thereabouts. It will be very granular, sort of industry sector by industry sector. This is what we need to do. And of course, for banks, we all know the bulk of our emissions come from our clients. They're financed emissions, not from our own operations. Of course, we'll reduce our own operational emissions, but the rest of the corporate world is going to have to fall in line, or else they won't have access to finance. And there will be all sorts of concern about different markets, different countries operating at different paces. And then there will be follow-on debates by governments around carbon adjustment tariffs or other steps the governments will take to effectively force all of us to comply. And in addition to all that, what we know is that the MNCs, so the industrial companies, are under tremendous pressure themselves to reduce their own emissions, and the bulk of their emissions are coming from their supply chains. The bulk of those supply chains are in developing markets. So there's going to be a lot of pressure on all of us, and from Standard Chartered's perspective, especially in the developing markets. The biggest gap, apart from access to good high-quality data, is financing. The financing gap is on the order of $3 to $4 trillion per year, every year, for the next 30 years. And that's a gargantuan financing gap to fill. In the developed parts of the world, about 90% of the necessary financing is or will be available. We know where it's going to come from. In sub-Saharan Africa, it's less than 10%. Right? So the way we look at this is that the biggest impact we can have in the climate the climate agenda is to get the financing that's necessary for transition into the hands of our customers, where our financing, obviously bringing together other people's money as well, can have the greatest possible impact on reducing net carbon emissions. And that for us means focusing on the developing world. So I'd stop there. We could go on forever, but this is a huge issue, both from a risk perspective, from I think a societal obligation perspective, but also from a profit motivation perspective. There's a lot of financing that needs to be raised, and that's what banks do, and we can do it profitably.
Investing in new technologies is essential for helping the global economy reach net zero. How do you see this evolving?
Yeah, I spent a decent amount of time in the last year chairing something that's called the Task Force for Scaling Voluntary Carbon Markets. I think some of the organizations in the IMC have participated in that. The idea is that there is a carbon market today, but it's very small. It's not very credible because a number of projects that have generated carbon credits over the past 20 or 30 years, either from the outset or with the benefit of hindsight, have not been effective. Of course, many others have been very effective, but it's always the bad apples that capture the news. So the objective of this task force, and we released our report on July 8th. It's our sort of final report. We're now into the implementation phase. Was to set a very, very high standard for what qualifies as a carbon credit, to create a governance body that can adjudicate those standards, not just at the outset, but over time. So think of board of directors. And then third is to create the facilities to scale up these markets. If we're successful with this will accomplish two things. One, it will set a market observable price for carbon that we can factor into all corporate and government level decision making. And we all know that without a price, it's hard to know what the cost of something is, and therefore it's hard to take action against it. Second, it will obviously transfer some money from the hands of people that can't reduce their emissions to zero, but want to, but feel the need to for whatever reason, into the hands of people that can actually get carbon out of the environment. There's two ways to. We all know that we must start with reducing our carbon emissions as much as we possibly can from our own operations, and we can pressure our suppliers to do the same thing. But that's not enough because we can't reduce to zero. We have to have technologies that will actually reduce the carbon from the environment. There's a very old world technology, which is planting trees. Trees and other organic matter absorb carbon. These are carbon sinks. I can tell you right now, the Amazon forest emits more carbon than it absorbs, which is an absolute catastrophe. It's the end of the world if we don't reverse that trend. So that's a good way to absorb carbon, is to plant trees. Unfortunately, it takes a very long time. The other way is very new world, whether it's direct air capture, with capturing the carbon from the air and sequestering it permanently below ground. It does no good if it's sequestered someplace where it leaks. Developing new forms of biomass to generate clean, green hydrogen, sustainable aviation fuel, etc. These technologies exist. We know how they work. They're just too expensive, and they're too expensive by orders of magnitude. So can we use some of the money that would go into carbon offset projects and actually divert that money into the basic research that's necessary to scale these technologies to economic viability? My answer is yes. Bill Gates, who's been the most thoughtful proponent of breakthrough technologies, his answer is yes. He's raised billions of dollars, both his own money, Microsoft's money, and other people's money. Is continuing to make a fundamental change in the pace at which we can deliver these scalable technologies. Without that, it's going to be very hard to hit our net zero objectives.
Coming back to technology, to what extent can digital banks disrupt traditional retail banking? What has been the bank's experience in markets like Africa?
Look, there's no industry that on the planet today that either hasn't been disrupted, isn't in the process of being disrupted, or will be disrupted, and banking is certainly one of those. A lot of the disruption in banking has come from within the banking sector. There are very large pockets of outstanding innovation, and I don't need to look much further than India, and you don't need to look much further than India to see that. And there's been an absolute digital revolution in India, and obviously the introduction of Aadhaar numbers and the associated benefits that come from that kind of scalability are outstanding. So no surprise, a lot of our own focus on innovation is either in India or coming out of India and applied to other markets. And I would say the bulk of our technical innovations are being built in India. That's the nature of our bank. So there's not too much that I can tell you that you don't already know, you members of the IMC. From our perspective, though, as a bank operating in markets ranging from very sophisticated to not so sophisticated, we see enormous disruptive opportunities. Yes, we see some threats as well, but I'd say that on balance, we see these as opportunities. So in Hong Kong, where we have a sort of tied for number 2 market share position, it's our most profitable market. It's big for us, even though it's a small place. We nevertheless have built a standalone digital bank to be a disruptor. And our standalone digital bank is focusing on different client segments than our main bank is. So it's focusing more on the mass market and millennials. We launched this the end of last year. It's done extremely well. We got about 3% of the population of Hong Kong has signed up already. 85% of the accounts are active. Customer satisfaction is extremely high, 4.9 ratings in the app store. So it's maybe amongst the highest rated financial services applications in the world. And we know how it works. Who are we disrupting? Well, we're disrupting ourselves a bit. We're disrupting the other incumbents in that market, probably more so because they've got a bigger footprint in the segments that we're targeting. But we told our team, the bank is called Mox. Hong Kong Tel and Trip.com are our partners in that. And we told the team, you go after whatever you want to go after. I mean, don't try to dance around Standard Chartered. You come and disrupt Standard Chartered at the same time as you're disrupting the rest of the market. And you do that by offering different products and services, more convenience, better customer services, etc. And it's working. And we're learning how to do this more and better. We hope to launch a similar bank in Singapore shortly. We will use the same technology stack. In Africa, we used technology that's not quite as cutting edge, but was specifically customized for the different African markets where we operate. We've added more customers in Africa in the last 18 months through our digital channels than we have in the prior 160-year history of the bank. It's because it's just a better proposition. The cost to acquire is 90% lower, 10% of the cost to acquire through the branch model, and the cost to serve is about 90% lower as well. Obviously, it makes economic sense. The customers prefer it, and it's nice that we can combine that with a good, robust branch infrastructure as well. That allows for those people that either just like the comfort of knowing that there is a branch, even if they never intend to go into one, or who actually need the branch from time to time, or all the time, it's still there. So, I mean, there are lots of ways that these markets will be disrupted. I think banks have the opportunity to be the disruptors rather than to be the victims in this, and that's certainly the approach that we try to take in each of our markets.
You've said before we are moving to a platform-based environment. Could you elaborate a little? We have a platform in India, Solve, from Standard Chartered Ventures. Anything that you would like to share on that?
Yeah, I mean, platform in some ways is the most overused word, mostly because everybody wants to be one or own one. And it would be wonderful to wake up tomorrow and be Amazon or Reliance and have that platform. And full credit to the entrepreneurs that built those platforms. But the fact is, maybe some of you own those platforms. I know we don't, at least not in that scale. But there are lots of opportunities to create platforms, either alone or in partnership. And part of what we saw in India, some of you will either agree or disagree with that. Little bits of what I heard from the prior panel suggest that there may be agreement. Was that parts of the small business community in India have a difficult time accessing professional services and accessing financing, and not that they can't or that it's not available, but it's a bit hard, and especially for a sole proprietor or a very, very small business who has no treasury team or administrative staff, it can be a real impediment to growth. So we built a platform, and it is a platform called Solve. There's no particular involvement of Standard Chartered in this platform. So we could provide services, we could provide financing. In some cases, we do and will. But for the most part, it's a platform for other market participants to engage with each other. It's a platform for small businesses to access financing. Some of you on the IMC are actively providing financing through the platform. It's a platform to engage with providers of other professional services. It's a platform to connect with your customers or with your suppliers. And we've got a couple of anchors in that regard. Samsung and Dell have been two early adopters of this platform, helping to deal with their distributors. It could be in a different context than their suppliers, although in this case it's primarily distributors. We've got, if I'm correct, Zarin, up to 60,000 participants now, and I think we're still in test mode. We're still in pilot mode. This could be a really meaningful incremental tool, a platform which is owned by Standard Chartered. It could be a really incremental, a really impactful incremental tool for small businesses to use, and obviously the objective would be to scale that. Does Standard Chartered need to own this once it's up and running? No, we don't. And I think we'll decide over time what the right and what the best way is to position that platform in terms of ownership and in terms of customer focus. But it's I mean it's interesting that in this day and age when existing very large platforms that have invested billions and billions of dollars are extremely present and effective, that there are still, it would appear, some niches for other platforms and people like us and you to participate and create some real value.
There's a lot of activity within the market, within governments and within regulators on crypto assets. What potential do they pose and what risks need to be mitigated?
Yeah, the meeting I was in just before this one was with our regulatory college, which is, for those of you that don't have the pleasure of meeting with your regulatory college, it's all the regulators around the world, so 60 countries. They all send a representative and they grill the various members of management for a few days. This is my turn. And inevitably, the question came up about cryptocurrencies. The comment was, we see that you're making a big investment in cryptocurrencies. How can you get comfortable with that? So first of all, let's not get into semantics, but we've not made a big investment in cryptocurrencies. We are making a big investment in digital assets. Cryptocurrencies are one form of digital assets. Central bank digital currencies are another form of digital assets. Stable coins are another form of digital assets. Tokenized carbon credits are another form of digital assets. So what we want to do is to provide our customers, we're starting with institutional customers. If there's the right demand and we can control it in the right way, it will extend to retail customers. The ability to deal themselves in broadly defined digital assets. Now, we all know that the bulk of what exists today in the digital asset world are cryptocurrencies. Bitcoin, Ethereum, XRP are by far the biggest proportion of market value in the digital asset space today. So no surprise that regulators and others will often sort of interplay the concept of digital assets with the concept of cryptocurrencies. Now, cryptocurrencies have a place in the marketplace. They exist in institutional portfolios today. They're used for legitimate means. No doubt they're also used for some less legitimate means. The advantage of a bank being involved in cryptocurrencies is we provide a compliance lens and a compliance filter that, at least for transactions that are going through us, regulators should be comfortable are very safe, secure, and appropriate. Of course, not to say that we get it right all the time, but we do get it right almost all the time, and better and better all the time. So cryptocurrencies are one part of this, but whether it's providing custodial services, whether it's providing an exchange or marketplace or market making, whether it's the structuring of other digital assets other assets into tokenized form and making those available to customers, whether it's acting as a distributor or intermediary for central bank digital currencies. These are all things that whatever else we think, they're probably going to be around for a while. And in some cases, like central bank digital currencies, not just likely to be around, the people who might be most critical of digital assets are the promoters, by definition, of a central bank digital currency. So our approach at Standard Chartered is to understand the piece very well, to create capabilities that serve of course, the entirely legitimate needs of our customers, institutional, eventually retail, and to do that in a way that we're understanding what some of the new applications can be, and understanding how we can roll those out in a safe and sound way.
There's a question from the audience. How do you see blockchain technology evolving for Standard Chartered Bank in the near future?
Well, I mean, but blockchain technology, I thought it was funny a few years back when it was all the rage, right? Everything was blockchain technology, and it's funny 2 years later that people were saying, all that noise, and look, there's nothing there. So blockchain technology was never a panacea, nor has it under-delivered against the potential that exists. Obviously, cryptocurrencies are underpinned with blockchain technology. That's fine. We see how it works. But I think more and more blockchain and distributed ledger technologies are making their way into very ordinary things every day. It's just a better way to save and share data through a secure database that's validated with each node in the chain. And some of the specific applications that I'm absolutely certain will develop. I think there will be distributed ledger technology meta registries around carbon credits, right? As this market really takes off, that'll be a very good thing. That will also make it much easier to tokenize those credits. In fact, it's a necessary condition tokenize those credits. Trade finance is an extremely burdensome administrative and manual intensive process today. And we all know that if we could get customs houses, insurance companies, shippers, and the importers and exporters who speak a common language to commit their data to a distributed ledger through DLT to a distributed database with a single source of truth, that trade finance process would become vastly easier, much more secure, much less susceptible to fraud, better customer satisfaction, and cheaper. Right? And there's always the question, well, but doesn't that put the banks out of business? I mean, we all make money on all that complexity. The answer is no, we don't. We'll make much more money if we can provide our customers with a really excellent product, which they can understand, which we can help them intermediate, which will then allow us to deliver the other products and services along with their trading flows, where we actually can add some real value and make some money. So I think there's lots of applications of DLT that we've understood, that we're developing, that aren't fully embedded, but it's here to stay. It's I mean, it should be a force for good, but let's not overhype it either.
There's one more question. With technology and 5G coming paperless, video banking will be future? The question is, will video banking be the future?
Well, video banking, it's really funny. I'm sure you've all had your own experiences with video chats. And I don't mean like this. I mean, where you're the customer and you've got some service provider. And sometimes often we find in banking, you really want to see the face of the person you're talking to because you're either very frustrated or you're very worried, or you're very, you don't have full confidence that the person you're talking to is credible. And in other cases, you really want somebody looking at your face, seeing that you're in your pajamas or that you haven't gotten out of bed yet, or that you have your hair in curlers or whatever. I have not had my hair in curlers lately. So as an incremental product and service to offer to clients, absolutely. I mean, we want to embed that in every one of our mobile apps and all of our customer service features, but in no way do we want to make it obligatory.
Thanks, Bill. There's one more question, but I thought that has been answered by you, which is, will there be office and branchless banks in future? I think that's what digital banks is all about. So I think that has been one final question. We have discussed how the bank's geographic diversity and unique footprint has played a key role in deciding the tech strategy. Along the same vein, what is the bank doing to leverage the diversity it sees within its workforce?
I mean, for us, diversity, it's a great curse and it's a great burden. Those are both negative, aren't they? It's a curse and a huge benefit. The benefit is that in any particular gathering of my colleagues, we're likely to have people with very different experiences, from different countries, different religions, different ethnic backgrounds, different socioeconomic backgrounds, and different sets of challenges. That's very, very rich. I think it does help us deliver better results. The flip side is we've got different cultures, so people that speak different languages. I'd say most people speak English, but who speak different ways of speaking that don't always connect. And especially if you've gone through periods as we have of people coming into the organization, other people going out, getting a common culture is a challenge. So net, I think this is an enormous bit of value for us, and we'll continue to try to develop. But it requires an ongoing focus on the cultural change that's necessary for people to feel comfortable sort of communicating across the cultural boundaries that we all experience in global finance all the time. And it's a constant challenge. But for me, I mean, if there's a single reason that I'm sitting in the banking industry and in Standard Chartered, which neither of which were conditions I met 6 years ago, it's to be able to sort of explore what it means to operate in such a multicultural organization with such a multicultural client base, and all the challenges that involves. I find it absolutely fascinating. I know we've run out of time, but I just have to say, first of all, extend my deepest thoughts to everybody on the IMC, who I know individually, collectively, and personally and professionally, you've gone through an extremely difficult time over the past several months. I know you're not at the back end of it, although I'm sure and I certainly hope that that things are improving. But I personally, Standard Chartered Bank generally, is 100% behind the people of India in fighting this terrible scourge. And I know that we can count on your support going the other way if as and when needed. So thank you.
Thank you, Bill. Thank you very much. Over to you, Mansi.
So that was the penultimate session of day 1. And I thank Mr. Winters and Zareen ma'am for an extremely enriching experience. And we move on to the last session of the first day of the conference. And this is on redefining financial systems, fintechs and payment banks. The panelists are Mr. Akash Sinha, co-founder and CEO, Cashfree, Mr. Prashant Ranganathan, CEO, PayU Finance Limited, Mr. Manoj Sharma, Managing Director, MSC, formerly Microsave, Mr. Rishi Gupta, MD and CEO, Fino Payments Bank. The session will be moderated by Mr. P.D. Singh, MD, JP Morgan Chase Bank, India. Over to you, Mr. Singh.
Thank you, Mansi. I hope I'm clear.
Absolutely.
Great. Firstly, I must say we've had a power-packed session all day. I hope everyone is with their cup of tea or coffee. We'll hope to make this as interesting as possible. Big thank you to Mr. Podar and to Mr. Basu. Zareen had a fantastic session, and all my co-members of the Banking and Finance Committee for getting us all together and taking it to the next level. Very warm welcome to all our panel members and to everyone who's listening in. Earlier today, I think Mr. Podar mentioned that the fintech space is growing at a CAGR of 22.5%. Mr. Basu also explained the important and symbiotic relationship that fintechs have with banks. So setting the context, I think we've seen the supersonic and stupendous growth of the digital transformation from 2015 onwards. And of course, for payment banks from 2017 onwards. And there's no doubt they've played a very critical role in this. Of course, it's no surprise that India is third in the ecosystem of startups. And again, it's no surprise that a very large number of these are in fintech areas, such as credit, payments, investments, and insurance. Let me start first with Akash, who's the young and dynamic co-founder of Cashfree. This is a company he founded in 2015. He's a techie to the core, a software engineer who started his first startup while he was still in college and went around setting up, acquiring clients and merchants in 2015 on his own to today, where he's one of the largest in the space that they operate in. He's worked for Amazon, Bank Bazaar, and of course is someone that is very popular on the speaker circuit. So Akash, starting off with you, I know someone asked you just last week, are you buying a bank? And you vehemently denied that. But you've been growing in leaps and bounds. You've tied up with the largest bank in India, so many congratulations. I have two specific questions for you with relation to the topic today. So a cool technological company, how does it get into the stodgy space of regulated banking? So how does this kind of partnership work? And the second question was more, bread and butter kind of question, where we're talking of transaction volumes and patterns, and maybe you can explain something that you're seeing around that. So a little disjointed in terms of questions, but I think the first one is very pertinent to your recent partnership. So we are all very keen to hear from you.
Great. Thanks, Piri, for that great introduction. And also thanks again to IMC and members for inviting me on this show. Coming to your first question, see, I mean, India is a country, right, with a very large population, right? We have 1.4 billion people. And every day we come across challenges which is not possible to solve through traditional ways. We have to use technology everywhere, right? And fintech is not exemption, or I'd say instead of fintech, banking or financial services is not exception. So when we were starting this company back in 2015, we saw this pattern in the market, right? We saw a number of problems around financial services are growing. But at the same time, we saw companies, because of could be lack of focus or unable to build the technology, they are unable to go after those problems. Right? So we as a company identified those payment problems very early in our journey. And we thought, why shouldn't we go and try building a good, technological product around it? And one of the problems we picked about, sending money to someone else, right? Very trivial problem. As part of all the businesses, every business has to send money to their customer, vendor, stakeholder, sellers, right? But everyone was struggling to do it properly, efficiently, right? We came across a company who had a almost fleet of 1 lakh, on-demand service provider. And they used to take, just 3 to 4 days every week just to process wage payouts to them. And even doing that, if they make mistake with 10% of them, right, that will constitute almost 10,000 of people, right? So imagine 10,000 of people not receiving the salary on time. And these are, daily bread earners or wage earners, right? So we went after these kind of problems. We built a very automated solution, right? So that there is a very minimal chance of error, right? System works automatically, system can verify things. And we were able to solve this kind of dispersal problem at scale. Right. So today at Cashfree, we process almost 3 million such transactions on a daily basis, right? And we also, process at a very high speed, right? Again, I'll take you to the second problem, right? Suppose you have, like 50,000, service providers on your platform, right? If you start sending money to them, say in first 3 hours, you just send money to, 1,000 of them, then remaining the guys would start panicking, right? They will not know whether they'll receive money or not. It's important for us to process this entire set of, dispersal in a very short amount of time, which means we have to do it at a very high, TPS. TPS is transaction per second. And where we see, banking as a segment may not be very ready with this kind of high scale processing, right? They have solutions around, SFTP, bulk processing, but they don't have this real, solution around real time processing of a high scale, requirement. And that's where companies like us fit in perfectly, right? We can be the front end to all these kind of customers in the market, right? They can use Cashfree as an interface. We know the strength or ability of the bank, and we can decide how to use that ability in the best way, right? So tech companies are sort of abstracting this, entire interface, all the fintech companies, right? Banks are involved into, like hundreds of operations, right? They cannot be best everywhere. So they are best in certain segment, but places where they are not, very great at, or they don't have bandwidth to spend time on, they can come and work with fintechs like us. We create abstraction layer. We, serve the end customers. We use the bank. At the same time, we make this entire a win-win for everyone. Right? We solve the problems, but at the same time, we also keep the banking system engaged with those kind of customers.
Akash, with a low fee, and that's, I think, plagued the system. How do you think, if you were to crystal ball gaze a bit, how do you see this evolving?
See, it surely makes the life hard, but I think, if you're running business in India, see, you have opportunity of scale, right? That is something I'll tell, right? We have very large market, right? The market is also changing very fast, right? Just look at UPI. 1 year before April 2020, we are doing like 1 billion transactions in a month, right? April 2021, we did like 2.7 billion transactions in a month, right? So as a country, we are growing very fast, right? Number of people coming to this banking sector or the financial inclusion segment is also growing rapidly, right? Every year we'll see, easily 100 million, new customers coming in this platform, right? So yes, margins are a concern, but at the same time, we have opportunity. And secondly, we have enough problems to solve, right? So the company has to be nimble, they have to be innovative, right? Today, no one can say I have built a good product in this segment, now I can relax for 3 years, right? That will not work. So we always have to be on our feet, right? Be hungry, be ambitious, and that will make sense of, running a large business, right? And that benefits everyone, right? It reduces cost, it increases efficiency, plus it also makes company more inventive, right? That is more important. Otherwise, there won't be any push to be inventive, right? I can be happy earning a high commission, and then there won't be any need to innovate.
Right. So low cost and a large, high-speed processing engine is what you're adding probably to the banking sector, is my takeaway from what you just mentioned.
Right. We are partnering with bank, right? We are able to solve problems where we see banks as a segment are not able to do it a great job because, as I said, they are involved into many tasks. And fintechs can go after very few opportunities, but that will make fintechs large in itself. Right? Be it dispersal, be it recurring payment, be it instant refund, or be it issuing. Right? Fintechs issue cards, they issue accounts, and Cashfree is trying to play a role in all these major areas.
Fantastic. So Prashant, I'm going to put you in the spot next, but before that, as the CEO of PayU Payments, baptism by fire, getting your baby sold to PayU right just before the pandemic, and then taking over a large business with 400-500 people. You've been a serial entrepreneur as well, with PaySense being your third startup. I've heard when you joined PayPal in 2011, and then they moved you to India in 2015. I think your buy now, pay later was your idea, which you wanted to implement and put forth. But be great to hear from you about what you think about this space and what you're seeing right now. As a brief introduction, I think you're an engineer from New South Wales and bachelor's from Stanford. I think you started off with Microsoft. So an entrepreneur who's had a good mix of big corporate exposure and someone who knows that one size fits all doesn't work, at least in the Indian context. So over to you, Prashant. I think it looks all very simple, but we want to know how it all works with the PayU engine giving you a number of customers and a business model where you have the access to capital, but you are facing a lot of challenges in the current environment.
Absolutely. Look, it's a pleasure to be here. So just a quick correction. I'm actually the CEO of PayU Finance, which is the credit business of PayU. Anirban Mukherjee is the CEO of PayU Payments. So that's just a quick correction. But everything else is pretty bang on. So look, I think you're absolutely right. We were quite fortuitous to have consummated a transaction in January of 2020. And as we all know, come March 2020, the world was a very different place. There were three very key reasons why I did the transaction. One, because, like as you said, back in 2015, I actually wanted to build buy now, pay later for India, right? Because I saw e-tail as a sector just have explosive growth, right? This was the time when Swiggy and Flipkart and Uber and Tiny Owl and a bunch of other companies were just taking everything that we were doing in the physical world and doing it online, right? So we were going from an atoms world to a bits world very, very quickly, and it was a transformative time for India. So I actually moved from PayPal to start PaySense to actually build a buy now, pay later company, just to make payments that much more easy. And I think I relate from a consumer standpoint to everything Akash was mentioning as well. It has to be fast, it has to be reliable, it has to be easy, it has to be low cost. And that was the intention. And to be honest, the best payment experience is no payment experience, and that's what buy now pay later is, right? So you do a click, and then you whether you get your biryani or you watch your movie or you get your taxi, everything just happens, which is what you really care about as a consumer. But the payment is something you deal with which is a monotonous task. You just deal with it another time, right? That's the whole idea of buy now pay later, is to remove all friction from a transaction that a consumer wants to engage in. Of course, if you look at the business model, a pay later business doesn't quite make sense as a venture-backed company, right? So we actually very quickly pivoted away from that and went into the world of personal loans, and we built that business for 5 years. But when the opportunity came in 2020, I actually bought LazyPay out of PayU to become, make it part of PaySense, and then became PayU Finance. So that was, it was kind of a full circle for me. So wanted to start with Pay Later, ended up building a personal loan engine, and then bringing the Pay Later business back into it. It's actually, in many ways, it's been an accelerated year, right? So for us, we definitely enjoy the parentage of Prosus, Naspers, and PayU. We also benefit from the very large scale, low cost customer flywheel that our buy now, pay later or deferred payments engine delivers us. So we onboard a few 100,000 consumers every month. And then we have the opportunity to then cherry pick, run our analytics, run our models, and then figure out who we want to lend to and at what scale. And that actually plays a huge role in lending. So I think for lending, I'll just summarize by saying three things have to come together. You need to have a low cost and high volume customer acquisition flywheel, which we get from our lazy pay engine. You need to have your proprietary data and proprietary analytics and technology, so that you basically have an advantage over the rest of the market, which we do through our payments business as well as our credit business. And third is you need to have access to this low cost capital and very, very deep pockets, because that is the raw material that goes into our business. So of course, we have a lot of that ourselves, but we also partner with banks and other NBFCs to make that available. We've been quite lucky that we've been able to bring all three together this last year. And the pandemic has just accelerated digital adoption in many ways. So I think that has also been, if there is a silver lining to this whole thing, then that's probably the one we've seen.
No, thank you. Thank you, Prashant. Very insightful. I like the way you put the flywheel and how easily you make it sound so simple, right? But we'll come back to you to explain the complexities later.
Sure.
I want to move over to Rishi. Rishi is one of the pioneers in the payment bank space. Something that he's done, I think not many could do in 3 years of starting a payment bank, a physical digital model, which we now know as Phygital, even during the COVID environment. And Fino, of course, has the national agenda of financial inclusion and the universal access to banking. So Rishi is also the co-chairman of the ASSOCHAM National Council on Banking and Financial Services for this year. So Rishi, you've seen the underserved space from very close quarters. I've heard you talk about this on TV, and you've talked about the role of payments bank. So firstly, please do share that once again with us about role of payments bank in the context that we're talking of today. And secondly, like we heard from Mr. Vishwanathan earlier today, there's a large unserved banking section of society. And I think Fino's reached out to a large number of those constituents as well. So what's the plan there, and how does that fit into your overall profitability and sustainability target? You're on mute, Rishi. Yeah.
Thank you, PD, and thank you, IMC, for giving this opportunity to share our journey as a Fino Payments Bank. You're right, actually, PD, bang on in terms of that we have been seeing this set of customers for quite some time now. In fact, Fino is completing 15 years this week. So we are a 15-year-old company, and we have been working with this single agenda of bringing access to banking for the unbanked, underbanked segments. So I would say in the last 15 years, I have seen the journey transfers in a very different traction. I would say the way I look at it is pre-UID and post-UID. So the UID has actually changed the way the entire transformation in banking is concerned, and also in case of the financial inclusion thing. The second big thing is the Jan Dhan accounts, which came post 2016 onwards, where nearly about 40 crore accounts got opened, and people now have maybe a 2 lakh crores in those Jan Dhan accounts. And the third is the revolution which mobile banking actually brought in, especially on the smartphone category, if I look at. So the government agenda on JAM, Jan Dhan, Aadhaar, Mobile Trinity, has actually pushed the entire financial inclusion agenda into a very different orbit. When we started Fino 15 years back, there was no identity, there was power issues, there were connectivity issues. So a lot of those issues have been sorted now to a large extent. I would say, so earlier we used to carry a suitcase, and which had a camera, we had a laptop, we had a fingerprint scanner, we used to issue smart cards, which were working in offline manner. So from there to a completely online platform in today's world. And I would probably fail if I don't mention NPCI, National Payments Corporation of India, which has actually transformed the entire payment agenda in the country with UPI, with IMPS, with BBPS, FASTag, so many solutions which have come out of NPCI in the last 5 years, and that has actually transformed the entire financial inclusion agenda. So while we are there on the ground with lakhs and lakhs of points across the country, I think the rails which the government have built, the regulator has built, the openness in which the regulator has actually allowed financial inclusion to happen in the real spirit, not in just in the books. has actually transformed when one of the examples which I can share with you is when the government actually dispersed 10,000 crore rupees during COVID-1 and 10,000 crore rupees per month to about maybe 20 crore beneficiaries. And at that time, the branches were not working, the ATMs were not working, and the entire ecosystem of merchant payments bank ecosystem actually was able to disperse that money to the last mile. Over the years, what has happened is the technology has become a commodity, if I would say, from the expectation point of view. People in rural India also don't want to wait for maybe more than a minute or so to have their transaction. So technology, availability of technology and network is a given thing which has happened, which was not there 10, 15 years back. So the entire journey of payments bank, especially if I look at the Fino journey of the last 15 years, from a very low technology, low identity, and no low network issues, we have moved to all those things have been taken care of. And I think that is while a lot of credit goes to the people who are working on the ground to make it possible. But I think a lot of credit also goes to the ecosystem which has got built up in the last 10 to 15 years. And the openness in which the banks and the regulator and the government has actually pushed this agenda is very heartwarming. Another thing, as a payments bank, you were asking me in terms of how we have been able to transfer such journey. So when we set up the payments bank 4 years back, in fact, we are completing 4 years this month. And when we started the payments bank at that point of time, our aspiration was always to become a national player. You know, a payments bank, the kind of people who have been given licenses are all national big players in the country. So our agenda also was to become a national player. At that time, we thought we'll set up branches and do transactions through branches, and we'll provide the best of technology to make that happen. But over the years, we realized that if we have to become a pan-India player, we can't have a branch network. So I would say branch banking, and I heard my speaker, another speaker before this panel, also talk about that the branch banking is kind of not growing and it is of the past. And we have to look at different avenues in which we can service the customer. I think COVID has further accelerated this, and the customer has a choice to either go to a merchant or to go to a mobile to do our transactions. And as we know, we do millions of transactions running into billions of dollars every month. So the entire ecosystem has actually developed in the last 4 or 5 years, and COVID has further accelerated the entire adoption of consumer to digital means, especially I would say for cash withdrawal, deposits, remittances, and bill payments, recharges. So a lot of new products have come up through payments bank ecosystem. And I would say right now, if you ask me, payments bank are in a sweet spot because we don't do credit. And I would say the Prashant would might not like it, but the fact that credit is a difficult world right now during the COVID situation. But at some point, I think with the data and everything getting built up, the credit will again try to grow. But we are in a sweet spot, doing well, and hopefully we'll continue to do well.
No, fantastic story, Rishi. Thanks for sharing that. And I agree. I think the credit cycle will come back the way consumer data in the past has been used will be leveraged again. Maybe payments bank will also be allowed to lend one day. But let's see. As of now, you focus on doubling your deposit numbers as we've seen with the recent guidelines. So let me move on to Manoj. Manoj comes to us from a research and consulting background. He and his firm MSC have had extraordinary experience working on providing financial services to customers, more so in the underserved categories. So Manoj has 25 years of experience working for policymakers, various types of banks, NBFCs, and even fintechs are part of this. As I discovered when I met him a couple of months ago, when we were looking at the Financial Inclusion Lab, which was supported by a few institutions like Bill and Melinda Gates Foundation and JP Morgan as well. So, Manoj, I want to pick your brains on two specific points, one on payment banks and one on fintechs. I think a lot of our audience would like to know this. I've already got a few questions on this. So everyone wants to know, will payments banks ultimately just all become small finance banks? And I know Rishi has publicly put out media statements saying there's no hurry to do this. But what's your take on this, and how do you think this landscape will develop? And then my second question on fintechs was that categories of payments and credit have been the favorites. There has been a little bit of change, but again, is there any huge evolution or innovation that you see which we may have missed while watching this space? So over to you, Manoj.
Thanks, PD, and thanks to IMC for the invitation to join this panel. So yeah, I mean, as Rishi said that, and he's now heading a profitable organization. So both Fino and Paytm sort of broke even a couple of years ago, actually, last year for Fino and a year before for Paytm. So actually, they have built a sustainable, scalable business model, and I think that's a pretty huge development in terms of taking the model, because the model had become somewhere suspect. I mean, if you look at the history of the way payment bank started, out of the 11 licenses that were given, not even half finally started off. And today we have actually 4 visible names that are there in the market. And with 2 of them turning profitable, it's actually quite a statement. And I think this ability to reimagine the banking business, that, okay, we'll take a sliver of the business, but we'll scale it up to a level where it becomes profitable. I think this is the key lesson that we have from payment banks. And actually, it was very interesting. A couple of years ago, there was a team from the Central Bank of Nigeria. They came specifically to look at payment banks, and they went back and actually verbatim called it Payment Systems Bank, and they have replicated the entire model for Nigeria. So I think it'll be very interesting to watch this space. I know that there are banks in the payment banking space who are absolutely dying for this 5-year sort of cooling period that RBI has put in, that you need to be a payment bank before you can apply to us for a small finance bank. So we'll see both of them. But I think at the end of the day, there will be on the management of payment bank to expand, to have a wider product basket, because there are investors. At the end of the day, there'll be investors backing these giant institutions. I mean, the key thing about, and Prashant alluded to it, is that the moment you are in the financial services industry, you have to have deep pockets. And the moment you have deep pockets means you have investors backing you up, and this is capital that needs returns. I think that capital that needs returns would eventually drive payment banks towards a small finance bank model, because it opens up more avenues. And it is to the credit of both Fino and Paytm. And frankly, Rishi and his team, they managed to turn the institution around. I know where sort of Fino had reached at one stage. So it's very, very credible, I have to say. But given that now, of course, having built this large distribution platform, I think it will make sense as well to have a broader range of product bouquet. And credit, of course, every financial services business in the tech world sort of starts with payments. Payments is the first, probably, without sort of in any way belittling the huge, systems and platforms that have been created. It's the first crack at it. It enables scale, it enables volumes, it enables sort of early, not easy, but early profitability to come in. Credit is the next sort of frontier. And then to answer your second question, PD, we are seeing that insurance is actually getting a lot of traction. And it is very, very interesting for us that the whole insurance market, people always understood insurance, but in India, somewhere insurance got tied into with Bima Nigam, and this is a long-term investment. You put in money for the long term. Nobody ever sold insurance as insurance. It was always sold as a savings product, a long-term savings instrument.
So do you think this is because of COVID?
COVID has changed that. People, they are talking about, I mean, if you talk to rural clients, what is it that you need? They say ki bima hota to acha hota. If I had some form of insurance, health insurance, it would have been good. The other thing they are talking about is bachat is important. So I need to save now, because eventually that's what jo mere paas tha, that's all I could rely on. Everything else was out there. It is a promise. Even if you were a credit customer to a microfinance institution, you could access them. There was no way you could reach out to them. So I think these two things have absolutely struck home, and you will see that we're already seeing that, for example, gold loans, and this is just public sector and banking sector, so to say. Forget about the Mannapurams and the Muthuts. Gold loans pre-COVID, post-COVID, there is a 3x multiple. Yeah, because people understand that savings, whether it is in the form of gold or it is in some form of a financial instrument, that is what is going to save you at the end of the day. So I think we'll see PD an uptick in both savings and also insurance post COVID. And I think the sort of platforms that both Akash and Prashant have built, I think they should really be looking at that. Is this the diversification time? Because huge platforms that have got created by most fintechs, and of course the likes of Fino already have a more diversified platform. So I think this is what the message we are getting from the field, that we are open to these products. And the other thing we are seeing is that even gold backed savings products, they are seeing an uptick. So it's a very interesting market that has got sort of created because of COVID, for all the hardships we went through.
Right. So Manoj, since you mentioned COVID, I know you have a fantastic report which is available online. But would you like to just put out a few points from that report for our audience, just to whet the appetite on what exactly you saw during this period? How was your study? I know you did first phase, second phase as well.
Yeah. So, I mean, from a client perspective, actually, for all the flag that the government gets, they manage the situation reasonably well. I mean, if you look at 93 to 94% of the people said they managed to get food grains. And the moment 93 to 94% people say they get food grains, we are talking about 820 million people in this country get government subsidized food grain. It is the largest single subsidy program anywhere in the world. Nothing else gets to any close to the scale. So to have the ability just to manage the logistics, and the government decided that we'll give you 1 kg of dal as well. Dal was never a commodity that was distributed, and they managed it reasonably well. Rishi talked about 220 crore women getting 500 rupees into the bank account every. The hit rate in the first 3 months was upwards of 80%. So 80% people said that we have the money, we can sort of act, we haven't withdrawn it, we couldn't withdraw it, couldn't access it, but we have the money. So I think on the sort of consumer side, the government, whatever little resources it had, it managed to reach that last mile. The jury is out there on what it did for entrepreneurs. We'll not go there. But in terms of its constituents, and I mean, government always says that the poor are our main constituents, and that's what we need to. They managed to get there. In terms of sort of, if we talk about the fintechs, the startup universe, of course, in the first round of COVID, went through a lot of churn. There was a sudden tightening of fists. Money wasn't available. It became much more difficult to go out there. So I mean, capital always becomes scarce in an uncertain situation. A downturn, predictable downturn, you can navigate. But I think this was a situation that nobody had ever envisaged. So in that sense, it became, so especially credit startups really had a challenge. We had startups who folded up, were sold in this period. But in the second round, I think people managed to sort of navigate better. We learned how to navigate in this situation. It was, I think, despite that it was a much more severe downturn, it was okay. It'll be another 6 weeks and we will come out of it. Or maybe it will stretch to 8 weeks. So in that sense, it happened. If I were to look at the credit business from a microfinance perspective, 90% repayment rates were achieved. Once the lockdowns were lifted, over a period of 2 to 3 months, we managed to get almost 90% of the money back, which was very, very credible. I mean, if people are willing to pay, poor people are willing to pay, even in this situation where they themselves are struggling. For me, the message was that this is a very, very bankable segment. And I think that's the other message that large fintech players should take, that, getting to this segment, because the large banks can't say that, their repayment rates have hit this level, or defaults are below 10%. But that's what the microfinance industry has managed to get to. So I think a lot of positives. It has managed to build in a resilience in institutions that otherwise might have taken us many more years. So we are all much more efficient, much more sort of driven to overcome these challenges.
Very encouraging findings, Manoj. I'd encourage everyone to have a quick look at the report whenever you can. But I'll pick something that you mentioned about customers and probably shift gears to customers and focus on, eventually I think every business in financial services rests on what the customer needs and what the customer satisfaction is. So I think the sort of segmentation, the fine tuning that we were used to as bankers has got fine tuned to the extent that we could never imagine in the current digital environment. So whether it's in terms of income, literacy, demography, gender, whatever it is, whatever parameter you want, you can cut and slice the data on that. So I'd like to pick your brains as the panelists on how you've used this or how this has worked for you. So Prashant, maybe I'll go first with you as to how you look at these segments, and is there any learning coming out of it, or is there any differentiated offering? How does it work for you?
Yeah, so I think, look, any self-respecting data organization or technology organization will tell you that you have to drive a charter of mass personalization. What do I mean by mass personalization? Is that you can't bucket a million Indians as one cohort and have, like, a few of those buckets, right? The size of n equals 1, right? So basically you have almost 200 million cohorts, and each person is an individual, and you treat them as such, and you personalize and tailor your products and your processes and your underwriting and everything to n equals 1, which means every person gets a slightly differentiated, slightly personalized experience. And I think that's more of a DNA, a mantra that we have followed since day one, right? You have to be, to be called a data centric company, data science company, you have to go to that level of personalization. And I think that has benefited us. Of course, in the early days, it was quite a tax to bear, but I think that has benefited us significantly over time, because now we can predict what is the next best offer, what is the next best product for which customer, and we don't have to do that in an offline batch analytics way. It is done by the system for the people, and it's done hundreds or thousands of times per day, right? Like, it continuously modifies, what to offer whom, and then figure out the propensity for that customer to take on that product and benefit from that product. Pricing is set dynamically, processes are altered dynamically. I think that's the holy grail. I think that's where we all have to get to, and it's through this personalization journey that we realized that there were consumers who came to us for convenience, who just wanted that quick, fast payment experience. Then they graduated at some point to kind of an affordability play, where they wanted to check out and buy products online, but they wanted to kind of break those up into EMI payments. Then there were consumers who would then come back and borrow, small pots of capital from us, whether those were, for their business needs or for their personal needs. And in COVID, there was a lot of it was health-related needs. That was, tailored to them. And now what we're seeing is, I think I'm absolutely with what Mr. Manoj Sharma was saying. We are seeing a huge demand for insurance. I think people are coming to us and saying, hey, how, we came to you, we benefited from the trust that we established here, and now we're looking for insurance. And they're not looking for life insurance. They're looking for kind of very sachetized, very custom fit insurance. And so now we are working with the insurance industry, of course, to kind of create those sachetized, create those personalized insurance products. Whether it could be as simple as, like, a mobile screen protection, right? That they want to insure that, to health of their family, to health, and life, of course. So I think we are continuously learning from our consumers, and our consumers are ultimately setting the roadmap for us for the future. And I think by just listening to them, we're able to just make sure that the products we build in the future are tailor-made and best fit for the consumers we have. And that's also generating more consumers in return. So I think that's how we get thanked for it. So yeah, that's been the journey. I think it's 6 years in the making, and we continue to benefit from it.
So, Prashant, I'll always remember your mantra, n is equal to 1, right? So, Akash, if I've got it right, your customer segment is largely business customers,
Right.
slightly more sophisticated or having slightly more different needs. So, how do you cut and slice this, and how do you have differentiated products as well?
True. So, see, for us, I mean, this market is very heterogeneous for us, right? I mean, there are companies who are coming to digital payments ecosystem for the first time, right? They may not be very tech savvy. They do not want any API. They just want to get their work done, right? So we have come across insurance companies who before COVID used to, visit these clients and get their premium in person. Right? So after COVID, they just wanted some digital solution, just to get premium from them on time. Right. So for them, we just built a bulk upload solution. You just give us the data, like very trivial, very standard solution, and they can pay premium through their UPI or net banking or whatever channels they have. Right. Then we have customers who are slightly tech savvy, all the online businesses, which most of these startups are getting into. So these guys are, like slightly more sophisticated. Right. These guys focus on higher conversion. Right. These guys focus on giving a delightful customer experience. Things like, faster refund, things like faster checkout. Right. Then there are certain kind of customers whose ticket size is slightly higher. Right. And these kind of customers ask for, all these credit products on the platform. They'll say us, right, give me, 3 to 4 kinds of pay later product, give me like EMIs of this bank, right, give me debit card EMI. So we have very different cohort and, with us itself, right? Largely we have startups, right, who want to get things done faster, right? We have merchants, again, we have other customers who are focusing in global market, right? Wholesale, I have customers in US, UK, Australia. How can I collect payments from them at a cheaper rate and without having any fear of chargeback dispute, right? In international, that's a very big concern. So those are the problems we are solving, right? Then obviously there is big, after COVID, we'll have, like flux of businesses coming to digital payment for the first time. And the requirements are very new to us, right? We are learning, we are accommodating, right? And plus I'll just, set of customers who is saying, I have my customers want to come to digital payments, but they don't have the right instruments, right? Imagine, so you are running a school and just hypothetically, parents of those kids, don't have proper right account where they can make a digital payment, right? I mean, they may have some bank account, but they may not have debit card on it, right? They may not have net banking enabled on it. So how do I, increase digital payment penetration with my customer base? And that's the last leg of work we are doing, right? So far, Cashfree has been acquiring company, right? We are serving businesses whose customers were already banked. Now we are getting into a segment, where a customer of a merchant may not be banked, and Cashfree can help, issue payment instrument to them. Right? So we are launching very soon we are launching accounts API. So these merchants can create bank account with these customers by calling a Cashfree API. They can also issue them some kind of prepaid card. They can also issue them wallets. Right? And that is our approach of, improving the financial inclusion in the system, being a payments player. Right? Because we also have to work on increasing the overall pie, right? I mean, we can't just be, keep on exploiting the same pie which is there, right? It's a responsibility to increase the pie, get more and more customers, and that will boost the payments, as a business further.
Yeah, I mean, the scale and size that you talk about, and also the innovation that you are talking about, simple problems with solutions that can be used by all, right? So, quite fascinating. Rishi, I know you have a large customer base, and how does this work for you? What level of customer insights do you actually get, and is it possible to have products that or offerings that are influenced by this?
Yeah, PD. Obviously, you have to make products which are relevant for the customer. You can't sell a Mercedes to a guy who wants a Maruti and vice versa. So there are different segments of people who want different kind of products. And especially for our segments, which we are focusing on currently, are people in somewhere around maybe 2 lakh rupees to maybe 5 lakh rupees of income category. And they are new to bank, or when I say new to bank means they have a bank account, but they're new to the bank services probably. And they are new to the entire digital evolution which is happening or the explosion which is happening in the country. So when I look at and I would talk about the scale, and I think that makes a lot of importance in India. We at Fino have been talking about this from a very beginning. Is that in India, when you have 1.2 billion population, you can't make solutions which will work for 100,000 people or maybe a million customers. So you have to build solutions which can work for maybe 100 million people or 50 million customers in that range. So you have to build scalable solution, that is for sure. And when we look at our own customer segments, when we started the bank 4 years back, we did a very extensive research, and we came back with these three things which our customers were dying for. And these are basically which we acronymed as CSR. CSR in normally in companies meaning corporate social responsibility, but in our case it was convenience, simplicity, and respect. I think those were the three things which the people wanted very urgently, so to say, because they wanted convenience, that they can go anytime at their will and do the business when they want to do. Simplicity, opening a bank account, transacting through a banking ecosystem is difficult. And as the incomes are lower, the kind of respect they were getting at various outlets were not that level which they would expect to. So CSR was the basic theme, the central theme on which we built up the entire payments bank for Fino. Having said that, over the years we have seen that the customer requirements are changing, and what we have seen during COVID, and I mentioned earlier also, is that the alternate banking channels, the ABC of banking, is becoming more prominent than the banking per se. So people are looking at alternate avenues to come and do banking transactions. So like other panelists also said that there could be challenges with the bank, and bank has many things to offer. So similarly, when we look at this, there are opportunities or niche areas, and that is one niche area which Fino has picked up at that customer segment. And we have built up our entire ecosystem to service that segment so that he doesn't get overwhelmed or get scared of entering into a network where he doesn't know what is going to happen. Our customers are also not that digitally savvy. So we run on a phygital model where physical, assisted, and digital are kind of mixed together in a manner. So the customer behavior is changing. I have seen my digital volumes going up exponentially in the last 4 to 6 quarters. I've started to see people who used to come to us to do remittances are now opening bank accounts. And in that, we have multiple variants of bank accounts. There are about 5 variants of bank accounts at different price segments. And Fino has a philosophy that we don't offer anything free. We charge for every transaction because there is no point in giving things free because customers don't value free things, and you end up making losses and losses only. So to that extent, we charge for every bank account, and we created a first of its kind subscription savings account, which we call Shubh. That saving account has a fixed amount which you have to pay every year, and after that there are no minimum balance charges, there are no SMS charges, there are no transaction charges. Because one thing we realized, and that is the feedback which we got from customers, they don't understand the bank charges. Every month a few charges is levied on the customer. So in the light of transparency, they said, okay, you give us one amount and that should be enough for us for the year. So we created a subscription savings account, first of its kind. And similarly, along with that, we have offered multiple products on Aadhaar payment systems. We had fingerprint ecosystem. Now we added iris also to it, so people can withdraw money through iris, through eye scanning as well, and that success ratios are higher than the fingerprint success ratios. So a lot of things around that. Obviously, cross sell on bill payments, recharges, insurance. We are also offering gold loan. I heard Manoj talk about gold loan. Is absolutely right. There is a big demand. In fact, gold loan is seeing a higher demand compared to other lending products which we have partners with whom we are working. So on gold loan, we have seen there is a big demand, surge in demand, especially post-COVID. We saw that increase. So customers are coming and they are now trying and tested. I think one thing which is very important and one should not miss the fact that trust is super important in any financial transaction. And fortunately, we've been there for so many years and our merchants ecosystem has been there. And being physically present also makes our life easier from a digital point of view. Because if he has any challenge on the digital transaction, if there's a failure or there's an issue, he can go to a point and that problem can be solved compared to only digital companies where the customer have a problem. Where do I go if my transaction fails, or if there is an ombudsman issue, or there's a customer grievances issues? Some of the digital companies have not put that ecosystem. I'm sure the new guidelines of Reserve Bank, which they are focusing on a simpler kind of guidelines or a regulation for fintech companies, will kind of answer this kind of a question, where you will probably be asked to provide some kind of customer handling services or support in the times to come. But the phygital ecosystem is actually helping us to offer multiple products and handle their any customer service issues if there are.
Thanks, Manoj. You did mention about evolution of low income customers and how to manage or treat them. But let me move on to Manoj. Manoj, Rishi mentioned about this. So what do you think in terms of this segment and their needs, aspirations? Is there like a gender segregation or something that you have done that you are aware of?
So, I mean, we have very interesting sort of comparison points. I would say that if I were to look at the Kenyan market, which is largely a mobile money market, which is largely sort of phone driven market, we are now seeing clear sort of a digital divide emerging. But if you are largely urban male with a smartphone, you have a plethora of services available to you, financial services available to you. But if you are sort of in the rural areas, without access to a smartphone, without access to connectivity, then you are getting even more excluded. Because the fintechs that are emerging in these countries, because it has been a very mobile money mobile money led market, the fintechs that are evolving are riding on the mobile money equation, and because of which there is a clear sort of case where a lot of people are getting excluded, and it's quite a worry for policymakers saying, how do we bridge this digital divide? In India, I think Akash alluded to it, Rishi, of course, is doing it, that we have a better phygital sort of a channel available where, of course, Fino has its own agents. It is sort of out there. You can access it, as Rishi said, through phone or do it directly or go to an agent or whatever. But it is good to hear that even Akash is sort of looking at saying that how do I leverage merchants and go out there. That said, I think the first burst of growth that will always happen in urban areas, and that too in metros. So the first agents that were formed and were profitable were all in the metros and urban settings, because you get the volumes, you get the bulk to drive the initial profitability. We are now seeing that tier 2, tier 3 agents are also becoming profitable, because as the product bouquet starts increasing, profitability of agents, of channels can be improved. And then as Rishi said, that it's all about trust. If I can build trust in the channel, people will come and because financial services is about trust at the end of the day, especially more so savings. I mean, probably every product, but more so savings, because then I'm giving you my money for a longer period of time. The challenge, of course, would be to crack so there are three segments. There is the smartphone segment, there is the feature phone segment, and there is a no phone segment. For the feature phone and no phone segment, all we have is, frankly, that agent or that retailer interface that we can develop over a period of time. That agent and retailer interface is in the works. I wouldn't say that we have got there and we have cracked it fully, even though we have agent network has really blossomed in the last few years. But if I again quote from the study we did, about 13% of the transactions were done in agent point. About 23-24% were done at ATMs, and the balance largely were done at bank branches. And it was very ironical because typically a bank branch was at least a kilometer, 1.2 kilometers further off than an agent point. Yeah. So people are willing to walk that extra 1.2 kilometers because there is a certain, again, back to that point of trust. You know, I have more people there. I'm willing to go there, and you know, I have trust in that particular establishment. This guy might have charged me a 50 paisa more sometimes, so I'm worried because again I'm dealing in finances. The other thing very interesting that actually came from the more better off states, the Maharashtras and so on, was that, and this is something, Rishi, you should comment upon, you will know this, that we, for the first time, I had never ever imagined I would see this, but for the first time we saw that when we asked people, कि भाई agent पे क्यों नहीं जाते हो? Why don't you go to an agent? It's much closer. बोले ये तो अंगूठा छाप वालों का होता है, हम तो पढ़े लिखे हैं. We are educated. हम तो बैंक जाके काम करते हैं. तो and a channel getting tainted is, it blew us away. ये कब हो गया भाई? You know, but in India we are so used to पूरी caste hierarchy हमने यहाँ भी बना दी है. You know, we have created this whole hierarchy कि ये गरीब का channel है, so I shouldn't be seen in this channel. This was not expected. We are willing to go with trust, और you know थोड़ा वो charging हो गई वहाँ पे कभी तो या मैंने मेरे से नहीं हुई, I heard somebody say कि over charging हो गई. So this was very interesting for us कि channel को हमने मतलब एक वो पकड़ लिया है. So I think agent का हमें over the next 2-3 years we should see that agent, that merchant becoming more of a draw, because that is very important for me. अगर मुझे gendered way में, if I need the women to actually come in and transact at my point, she is unlikely to go to that bank branch. वो तो फिर आदमियों का काम हो जाता है. The moment we talk bank, it's a male. So we automatically bring in that sort of कि नहीं तुम्हारे लिए नहीं है bank. You know, you stay away from the bank. So for that agent, somebody I know, I trust, हमारे गांव का नहीं लेकिन बगल वाले गांव का है, that sort of a thing, it's very important. So I think that we need to crack. So भारत में जो actual inclusion होना है, I think there we need some more work. So yeah, 42 crore accounts and all of them, but 25-30% 25-30% dormancy is there. And I think that's largely because we are still not able to build that business case for this no phone segment. What will draw this no phone segment into the financial services, formal finance? I think that when gets fully cracked, that will open up a huge market for all of us.
Thanks, Manoj. I think we are in our last few minutes. Manoj, really fascinating the ground level input that you have given us, especially the one that you talked about. I thought, you know, like Rishi mentioned about respect. So this is beyond respect. This is more than it's your self-worth, right? Going to a certain channel or not. But anyway, very interesting stuff. Since we have our last few minutes, I'll just go around once for any closing comments. Akash, fascinating to hear about the way you spoke about speed, volumes, you know, the faster refunds, the global part, the digitization. So any closing comments, Akash, on how you see the evolution in the very long term, say 2030?
See, personally, I see fintech as an enabler in the economy, right? If you have to envision for 5 trillion, 10 trillion economy, I think fintech has to play a very big role. Right now, we see in our ecosystem that a lot of inefficiencies across the board, right? A farmer has to sell the product, they have to visit, stay in the line for 2 hours just to get the payment. You just automate the simple problem, right? People would save 2 hours of their life and they can go and spend in some productive work. Right? So there are a lot of such inefficiencies in the market, right? If fintech people start causing those inefficiencies, I think people would get more productive time, right? And then we can, contribute in a better part of the work, right? I mean, right now there's a lot of wastage,
Great. Yeah.
unnecessary wastage, right? I'm doing mundane things, trivial things, which should be done by system, machine. Let them do it, and individuals should do more intelligent work, more productive work.
Right.
That's the larger vision we have taken, and that's how we come across problems who are impacting the system and also rewarding for us end of the day.
Thanks. Thank you. Prashant, we spoke of the flywheel, the mass personalization, low cost acquisition, data analytics, and of course your key mantras. But how do you see the next 10 years, 15 years from now?
Yeah, so actually, I think the next 15 years are going to be massive amounts of acceleration. So I think we're right now plotting very linearly in our conversation. But I think if you think about it, we went from passbook branch-based banking to internet banking to mobile banking, and now we're saying okay, mobile to the masses. But I think in the next 10 years, the banks have a role to play, and I'll be slightly contentious. I think they become part of the infrastructure of the fiat. But I think this world of decentralized finance is going to catch on like wildfire. I think what we will see is there will be way more DApps. The crypto world that we are all just hearing about and discussing in very small closed rooms will be mainstream. I don't know if it'll be as mainstream as every corner of Bharat as it would perhaps be in every corner of India. But I think this is one of those things you can't cordon India off from. I think decentralized finance will be a very big part of I think a lot of the things we will be doing, and it'll just feel very natural. I think we will hold crypto as we hold rupees, and I think the banks will play a huge role. I don't think that they'll get disrupted, but I think they'll play a different type of role. They will be the providers of stablecoin in that world. That's
Thanks, Prashant. Of course, crypto for another day. That's another session altogether. But thank you. Fascinating inputs. Rishi, we spoke about so many things that you were talking about, new products, Jandan, the 40, the way UPI came in, and of course your own transformation that will happen eventually. I don't know if we are to believe what Manoj is saying, but I guess some of that is already happening. So where do you see yourself in the very long term?
So we have completed 15 years. I think to predict 15 more years is difficult. But what I can say is that we have covered quite a bit of journey in the last, especially in the last 5 years, and it will be wrong to say that we are behind everybody else in the world. We are much ahead. Whether we look at our payment systems, our credit systems, our technologies, it's and Prashant has been in US and he knows it better in terms of our banking ecosystem. Our fintech ecosystem is much advanced than many other countries in the world. So we are at it and we are getting it really well. And we have people like Akash, Prakash, who will take it forward in the next 15 years, I would say. What I would encourage people to talk about is also to talk about not only the top end of the market, to also look at opportunities of building a business case for the middle segment of the market. The lower segment of the market is still being financed by the government through their schemes, whether it's fertilizer schemes, food schemes, or cash, Narega and others. But the middle segment is something where the role of banks and fintechs and new technologies will be very important. I think there is where I see a kind of a higher acceptance of the ecosystem coming up, both from the supply and the demand side. I think that is something which I would personally be very happy if we are able to achieve it, because there is demand. The people are worried about the fact that there is not enough demand, and how will we service it? And if is it a profitable way to service that demand? Either demand is there, it can be served profitably. We need to get the supply engines, the supplier rail, and banks and fintechs will definitely play a bigger role. How will it happen? Difficult for me to crystal gaze and tell in the 5 years what's going to happen. But I can say for sure that things will work, and we will get all those 50 crore people who are in the middle part of the pyramid get good quality service.
Rishi, all the very best to you, and convenience, simplicity, and respect is something I will remember from this session.
Thank you, BD.
Great. Manoj, thanks for bringing the real world touch and feel to the entire session and for your expert comments as well. We are bang on time. So thank you to all of you for sparing your time, for being with us today. And I really enjoyed spending this time with you. I hope you did as well. So back to you, Mansi. Thank you.
Thank you.
Thank you for the interesting deliberations, Mr. Sinha, Mr. Ranganathan, Mr. Sharma, Mr. Gupta, and of course, Mr. Singh. With that, we come to end of day one. I also take this opportunity to thank all the esteemed speakers who spoke through the day, our distinguished panelists, and all you participants and delegates. Tomorrow we begin at 2 p.m. sharp. Of course, this is IST. So see you all tomorrow. This is Manasi taking your leave. Stay safe, stay healthy, stay well.
Thank you.